what's it?
Pledge of Allegiance.
Yeah. Let's lead Pledge of Allegiance. Tim, do you want to lead us in Pledge of Allegiance?
I'm not sure about that.
I just got settled.
You.
To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Good job, Tim.
Well, and where are we at? We noticed.
To remember it.
Yeah, much
Pull
better.
out my little.
Okay, so the next thing on our agenda is public comment. Members of the public are welcome to address the board on subjects both on and off the agenda. The board is prohibited from taking action on items that are not on the agenda, but may ask or briefly answer questions. Public comments up to 3 minutes. Do we have any public comment at this time? Okay. We'll go into the next item, which is discussion and possible action regarding consent. Okay, consent agenda. We have on the consent minutes of November 1st, 2017, November 17 retirement report, monthly preliminary financial report, and the 2018 board meeting calendar.
I think you're on the wrong one. Agenda.
All right. Okay. Let's take them all.
You're in 2017. It was a very good agenda, though.
Yeah.
That's one of our best.
Was a very good year.
Yeah, we'd love to relive that.
Maybe not.
So we have the minutes of March 21st, 2018, March 2018 return report, and the monthly preliminary financial report. Do we have any items that you would like to discuss or pull from the consent calendar? Not seeing that they're approved by unanimous consent. Next thing would be your discussion and presentation regarding the managing of the investment function and the investment consulting structures.
Thank you, Mr. Chairman. Trustees, we have with us today the esteemed Jim Thaler, the Chief Investment Officer at the Sonoma County Employees Retirement Association. Jim has a very impressive background. He's been with Sonoma County since 2007 and was promoted to CIO in 2016. Previously, he served as a client relationship manager at GMO, Grantham, Mayo, and Van Otterloo. Always confuse that one. Prior to that, he was an institutional relationship manager and product specialist at various investment firms. And before that, worked at Pacific Gas and Electric for their retirement, post-retirement medical, and nuclear decommissioning trusts. Jim has a BA degree in economics from Pacific Lutheran and an MBA from the University of Washington. He also holds the designation of a chartered financial analyst. Jim is here today to speak to us about managing the investment function and the investment consultant's role and structures within that. Jim, if I've missed anything in your very impressive resume, please correct me. But without me taking up any more of your time, please enlighten us.
Thanks. Pleasure to be here. Thank you for inviting me. When James asked me to first come, he sort of mentioned the outsourced CIO role, and then I sort of suggested maybe we can broaden that a little bit because put that in the context of who does what. There's that allocation of responsibilities, and I thought maybe it'd help to start to think through that whole process of who does what and what you delegate, what you keep, what you retain at the board level, what you retain at staff level. So it's a pleasure. I'll see you here all this morning. I've worked with Jeff Burke for a number of years at Sonoma County. It's a pleasure to see you, Jeff. So let's jump into this. Thank you for the introduction. So the arrow down, I think, is going to move us forward. Okay. So we're going to discuss decision making a little bit, and then the delegation issue, and then the outsourced CIO model, and then last I'll sort of tell you, briefly how we do it at Sonoma County, and that might be of some value. Just one example. There's no one right way to do all of this. There are a lot of functions that need to be managed and overseen, and it varies by organization what's optimal. So I don't have any answers other than just to sort of share some experiences and thoughts and considerations. And if you are considering changing who does what and how you use your consultant and staff, maybe these will help you sort of think through that process. So. I was going to introduce myself, just give you some background, but James did an excellent job of that, so thank you. I'll jump over that. But I've been in the industry about 30 years. I think in terms of the decade at PG&E, a decade working for investment firms, and then the last decade. And this is actually my 10-year pin. I just got this, so I've actually been there 11 years, but I just got the 10-year pin. So hey, I survived that long. So
And those 10 years.
Right.
Originally, James asked me if I'd do this, and I said I was happy to. And then he told me that you videotaped all this. And I thought, oh my gosh, well there go the pithy remarks and the off-topic jokes. So that's to be fairly straight, but I'm an adult now. This slide here is just making the point that we make decisions that are they're long-term in nature. This is much more like it's a big pool of assets. It's much more like guiding a super tanker than it is like a jet ski or something like that. So. We make course corrections periodically, but in general, these are very sort of long-term decisions we're making, like asset allocation, diversification, what kind of strategies do we employ over full market cycles. So I just thought we might discuss briefly decision-making. Different people do it different ways. Here they're voting on something, it's this board, and one of them's voted maybe yes, maybe no, and I find often I'm in that position. We were discussing well, we invested in a private fund that is denominated in pound sterling, so there's British currency, and the question was, should we hedge? And it's a really uncertain question because if you look at this, the statistics and the data, whether you're going to get a benefit from hedging or not is going to function of the volatility and the correlation with your asset classes, currencies to other asset classes, and that's unstable. And sometimes, depending on what 20-year, 30-year period of history you look at, currencies are uncorrelated with the major asset classes, stocks and bonds. Other times they're slightly correlated, sometimes slightly negative, sometimes closer to zero. And which period of time you look at and what data you pull from is going to affect the answer. Should you hedge or should you not hedge? So that's a really hard question. There's sometimes there's clear answers in investing, and other times there's just a lot of gray. And here I'm sort of making the point in this next slide, about some of the considerations when you're making decisions. And in my view, if you can work towards consensus, I personally think that's the best way to move forward, because you get buy-in from all parties, a little clear direction for staff. You avoid, hopefully you've vetted all the issues. People have fully participated, talked through all the considerations before you've gotten to the point where we're in agreement. Let's move forward with whatever this new issue is. Maybe in our case back in 2010, we decided to do farmland and add that to the mix of our asset classes. And we waited till we got consensus. We considered other things like timber, et cetera, and we finally settled on farmland as a diversifier. It's going to be easier to maintain your strategies, and a lot of these strategies, they're in favor, they're out of favor, there's cycles to them, and so I think it's important to employ a strategy for, when possible, for the long run, because you don't want to employ it 2 or 3 years and it performs, and now you get discouraged and you pull out of it just before it recovers. So that's called getting whipsawed, and we see that a lot in investing. So you want to you make most of these decisions, strategies, managers, unless there's new information. These tend to be they should be optimally longer term decisions that you employ over longer periods of time. And I think making decisions by consensus can support that. Delegation is the big issue, and as you're thinking about, if you're thinking about outsourced CIO or who does what, that's a central issue. It's what do you delegate, what do you not delegate, what do you retain, and a number of these slides have the Aon logo on it. So Aon Hewitt is our consultant. They've been our consultant for many years, and so I'll give them credit. And their logo is on the pages where I borrowed from them, so you can see that. You certainly can delegate. But when doing so, you have this fiduciary responsibility. You are fiduciary to the plan and for the beneficiaries, the members, and you need to do so as a prudent person. And some things to keep in mind when delegating, and I'm sure Jeff has probably gone over this before, prudence in selecting qualified professionals you're delegating to duty and specifying the scope of the delegation, duty to monitor the professionals. You can't just delegate and then forget about it. You need to oversee them and measure them in some fashion. They report back to you in some fashion, some periodicity, and duty of loyalty. And of course, as a 37 Act plan, your duty of loyalty is to the members and beneficiaries only. It's not to anybody else, it's to the plan. We all know that, but it's good to remind ourselves. I think as human beings, I'm susceptible to this. We have our inclinations and we try to rationalize, and it's good to sort of remind ourselves who would make these decisions for the members purely and nobody else. This is sort of a list.
Jim,
Oh,
if you don't mind, are you open to questions during
oh,
the comments?
absolutely, yeah,
Okay.
please.
I just wanted to, can you go back one slide? I wanted to ask a quick question, kind of delve into this a little bit further. I've always heard that as a board, you can delegate authority, but you can't delegate responsibility. Is that something that is in line with what you're talking about here?
Yeah, I think that is in line with,
Okay.
Jeff shaking his head over here, he's our attorney, so but yes, I think that
Okay.
yes, and that's why you have this duty to oversee, I think, and you're selecting a professional that is qualified and et cetera, so absolutely.
So you can give authority to staff or an outside entity, but ultimately the responsibility is still going to lie with the board. So, okay, sorry, just wanted to
No, that's a good-
ask that clarifying question.
Yeah. This is a list of some of the, common kind of issues that may be or may not be delegated. So the top category there is those kinds of things that are usually retained by the board. Allocate adoption of your investment policy statement, your IPS, that's your constitution. I'm sure you have one, and they vary in sort of structure and length. Some are very detailed, some are more sort of general. Your asset allocation mix, selection of consultant, custodian, these kinds of things. Some of the things that might be more often considered for delegation is selection termination managers, approval of performance benchmarks, active versus passive manager guidelines, these kinds of things. And then the last category is these frequently delegated things, rebalancing, fee negotiations, the RFP process when you're selecting a service provider, investment manager monitoring, these kinds of things. So, the next couple of pages are really a lot of those issues, sort of a long laundry list, and this matrix is sort of it's just a tool that you could use for sort of marking it up, indicating either how it's done today or how you want it to be done going forward, to sort of think through some of the major responsibilities and who does what. This is just a two-dimensional sort of chart. On the x-axis, horizontally there, you have sort of delegation level, less delegated to the left, more delegated to the right, and then internal versus external on the y-axis, the vertical axis. And so in this sort of concept, you'd have your fully outsourced CIO up to the upper right corner, the upper right quadrant, and then an extension of staff model where you're delegating, a fair amount, retaining some of it's done internally, some of it's done externally. That would be sort of the middle external extension of staff kind of model. And then OCD, the lower left, that's like OCD. So this is the board. So source CIO model. This is a survey that Aon Hewitt's quoting here. This is from the CIO magazine, and it's looking at how many plans outsource the CIO function. And for the smaller plans, they've defined at less than 500 million. And I think you folks are on 520, something like that. I think I saw at the end of the year.
Yes.
So you're about at this cusp, small to medium size. The smaller plans tend to outsource the CIO function 74% of the time, it says, 3/4 of the time, roughly. And then above that, it's more like 1/4 of the time. They break it out by type of plan too. There's public pensions there at 41%. And then the last bottom there, you can see 65%, 2/3 fully outsourced and 1/3 partially outsourced, roughly speaking, for those that do outsource, I guess.
What is the size of your portfolio?
Ours is between 2.8 and 2.9 billion. So when I came there, I was the first full-time investment officer. The assistant administrator was overseeing the investment function before I came there, and That was 11 years ago, 2007, and we were about $1.5 billion at that time. So that was the first full-time investment staff we hired, at that size, $1.5 billion.
Just out of curiosity, how far did your portfolio go down in 2008-9?
Significantly, because we're over 60% equities as you folks are, and we touched below $1 billion at one point.
Wow.
Yeah, just very momentarily. So, yeah. So as long-term investors, you have to be able to weather those, that volatility. And stocks are obviously, I always say that, this industry is very complicated. There's a lot of terminology. Derivatives make things very complicated. But at the end of the day, my view is there are really two kinds of investing. You're either an owner, which means you own equity. It could be publicly traded stock, it could be private equity, it could be equity in infrastructure. You own a toll road somewhere, but it's equity. What is equity? It means you have the right to any residual cash flows. You have your revenues, your expenses, you pay all that, if you're taxable, you pay your taxes, and then whatever's left over is yours. So the sky's the limit potentially, right? As an equity holder. Or you're lending, and if you're lending, you can only get back the coupon, the principal. That's the best you can do. Of course, you can buy it in the secondary market, pay less than 100. In the principal, you can get some appreciation. But at the end of the day, you can get the principal back and the coupon. That's it. So you're either a lender or an owner. It really is as simple as that. In a sense, there's different kind of ownership. As I said, there's infrastructure, there's farmland, there's real estate. But at the end of the day, you have a product or a service or a business of some kind. You're an owner or you're a lender. And if you're an owner, there's a lot of volatility to that. But as long-term investors, we can do a lot of that. If you go to the UK, you find pension plans that are 100% equities. And I don't think it's irrational. I'm an equity guy. I don't think it's irrational, but you do have to worry about the volatility over the shorter term because you have considerations like the stability of the contributions, and your sponsor can't be too shocked by the contribution stream varying too much. They've got only so much they can do. Of course, you do manage that with some smoothing, right? You probably have a 5-year smoothing or something like that in your market value. So that's sort of a philosophical discussion about stocks versus bonds. But yeah, we experienced that volatility just as I'm sure you did as well. Yeah.
And I'm sorry.
Go ahead, Jim.
I was going to say you smooth over 5 years.
Yeah. Mm-hmm.
So I'm of a like mind in terms of asset categories. You're either an owner or a lender, and that's the way I often think of the investment world. How do you characterize commodities and currencies in that kind of structure? Are those something altogether different? Because I've often looked at those as you're not owning anything and you're not loaning money, you're doing something altogether different. So can you talk about those two things in that?
So currencies are just an exchange medium, right? So there's no expected return in the long run on all currencies in total, like there is in stocks or bonds. So I wouldn't call them an asset class. You can, but so as I said earlier, the issue of whether you the usual issue that comes up with currencies is do you hedge or not, and that's a very hard question. Depending on the data you look at, it can sort of go either, what could be rational, optimal might go either way. Although I'd say if you have a currency hedging program, there's an additional administrative hurdle, which is that when you have a loss, you have to sort of cough up margin, which means that the losses are crystallized. So you got to have cash someplace to give to the holder of the margin. So so that's an issue. If you're sort of ambivalent or sort of on the fence on that one, maybe the administrative issue pushes you in the direction of not hedging because of that issue of crystallizing losses. Commodities, I look at similarly. I guess you could consider another asset class. We don't do commodities in Sonoma County, explicitly. We don't. Obviously, we have companies that are mining companies, kind of things that are impacted by commodities, and not everybody, but most firms are impacted by cost of oil. So certainly airlines or these kinds of companies are. So we're not directly investing in those things. What we've looked at it, not decided to employ it. So I guess you could argue that's another type of investing. The other thing that you know, beyond being an owner or a lender, the other thing that you can sort of do is you can push forward or backward over time with the use of derivatives, those characteristics. So derivatives allow you to sort of, you know, defer or pull forward that kind of performance from those basic types of investing, lender or an owner. So that's also a modifier to sort of that statement about either an owner or a lender. So anyways,
if I can, I've always thought of current as commodities specifically as neither one of those categories. And really what you're doing in commodities is that you're betting you're smarter than the other people. I mean, because you're buying something on an expectation that I can buy it low and sell it high to make a return. Well, the only way that happens is there's got to be somebody on the other side of the trade that's selling low and buying high. So you have to outsmart someone to make money in those spaces, which doesn't really make sense in my thinking about investing, with being very long term and focusing on owning something or lending.
Yeah.
That I really love that simple way of you either do this or you do this. If it doesn't work there, and those work long term.
Yeah.
So,
and the other thing I'd add to this, you know, your characterization I think is a fair one. You're making a bet on the future demand and supply for whatever that thing is, gold, you know, silver, whatever, and the market's doing that too, and you're betting you know more than the market, which of course is what you're doing when you actively manage any portfolio. You know, if you employ an active equity manager or an active bond manager, that's what you're doing, is you're employing somebody you think is going to be smarter than the market and beat the benchmark, which is, you know, that's pretty tough too. I mean, we have active management in Sonoma County. We have a good slug of, I would say, a passive core, index core, and longer term numbers. We've paid for active management and maybe a little sum, depending how you look at it. I would sort of look at it by asset class, but if you look at it in aggregate, you know, like we've added, I think the longer numbers are like around 50 basis points, which is about what we're paying fees, but some of those fees are unavoidable. So if you go into real estate, there's no passive alternative, right? If you go into infrastructure, there's no passive alternative. There's a passive alternative in equities, certainly in fixed income as well. And so you really want to look on asset class by asset class basis, but broadly, one of the things I've said to our board is, you know, we're paying 50 basis points about per year in management fees, and about half of that is avoidable and half of that's unavoidable. The unavoidable is the real estate fees, which there is no passive alternative. And so if you've added 50, you've sort of added 25 above your unavoidable fees, if that makes sense. So, but that's pretty, you know, and that's a lot of hard work over many years, and 25 basis points. Well, it's not zero, but, you know, it's not whopping. It's a hard game to play, you know, and on average, of course, the average person's going to be average, right? And on average, after fees, you're going to be under, right? I mean, that's just sort of math, right? If you're the average and then you got active fees, which are 50 basis points, 100 basis points, you're going to be that much under the benchmark, because you can get the benchmark for darn close to zero, not zero, but darn close. You know, U.S. equities, you know, maybe you don't even pay an explicit management fee because you do securities lending, and they take a share of the securities lending revenue, and that covers the cost of management for index management, or maybe you pay 2 basis points or something, but it's going to be quite low. So we're not going to start a tangent here.
You've layered the cake with lending and owning.
Yeah.
But how would you slice that cake in terms of real and intangible? I.e., you know, if you own gold, if you own real estate, it's always going to be there. If you own stock in Enron, you can wallpaper your bathroom with it.
Yeah. Well, it's a good. I mean, this subcategorization, absolutely. You can. You know, there's the Facebooks. What's their asset? I mean, it's a bunch of software. It's a bunch of, you know, bits. You know, zeros and ones, in a marketing profile, et cetera, et cetera. So. There's not a lot of hard assets there, but you know, you own real estate portfolios, they're hard assets. But if there's a lot of real estate, they may not be worth all that much at some point.
But it's worth something.
Yeah. presumably, and I do believe there's real assets have their place. We have a real assets portfolio, so we have real estate in it, we have farmland in it, we have infrastructure now. It was most recently we added that this last year. And so I think there's a real place. One of the nice things about the real assets is they tend to have a high income component. So you sort of, well, as long as you keep it rented, you can have that income component coming in, which is sort of a base, return base. You could think of it as, but then there can always be depreciation in the assets. So maybe you don't even capture that after, because we're all total return investors, right? I mean, but that bit of income is nice to have. And, I think there's a real place for real assets, but they're just part of the mix. And I think in this part of the mix, you have a lot of businesses that are very profitable, that provide great return, that don't have a lot of real assets, like Microsoft, So,
I know you're trying to get through that just real quickly. Do you do private equity? And is your farmland, is the philosophy to buy and hold, or is it to buy, convert into something else and sell?
So I'll take the second one first. Farmland is pretty much to buy and hold. We're a participant in the fund. We're the largest investor in the fund. It's a UBS farmland fund, and then they're diversified around the country. There's no leverage. They have a line of credit and they're buying a new asset, but they that quickly. They don't keep outstanding debt. So it's not leveraged. It's core. It's we don't operate it. The fund doesn't operate it. They simply buy it and then they lease it to farmers. And so it's like owning an apartment building and leasing it to, renting it out to people. They're long-term investors. I don't know if rarely they sold the farm. There is liquidity. It's an quarterly, valued fund. There's quarterly liquidity theoretically. Quite often, when they're buying property, they're buying it from a farmer that needs some capital. They got 3,000 acres, they'll sell 500 acres, they get the capital, and then they invest it, on their other properties or whatever, irrigation or whatever it might be. And now they rent back that 500 acres from us, and they continue to operate it. They know the property, they care about it, they want to be a long-term management, they want to manage the property over the long run. So that's quite often the kind of profile of farms we buy and lease. So. It has a nice income component. That's a real asset, and we're quite happy with that. It's never going to shoot the lights out. It's not going to hit the kind of returns you can get with stocks, but it's going to do a nice 5, 6, 7% kind of return, and a good part of that is income, like coupon on a bond. So, and I used to work at PG&E, and in the finance department, we used to say, our stock is really a bond, So it really acts a lot like a bond because it's regulated, highly regulated, and the infrastructure is like that. It's a lot like a bond.
We've taken a little bit on an off ramp from your presentation, but in that realm, are you guys invested in real assets within the boundaries of Sonoma County?
Not significantly. I think maybe you do. We own our building, but we don't have other investments beyond that in our county or specific to our county. No.
And are you into like multifamily housing anywhere?
Not directly. So we don't think we're quite big enough for that kind of direct investing. So we participate in funds that are open-end commingled funds that are quite big. We're a unit holder in these funds. So we're invested in the JP Morgan Strategic Property Fund, which is the assets are $32 billion. It's the largest open-end core vehicle out there, and we have an investment in that, maybe $120 million or something like that, and a similar investment in the UBS Trumbull Property Fund. Similarly, they own office and retail and multifamily and some industrial.
Thank you.
Yeah, but no direct investments.
Private equity?
Private equity, I wanted to.
Private equity. We're not an investor in private equity. People have different opinions about this. It's certainly right. We're fee sensitive. My personal opinion. This is just my recommendation to the board, and they make the decision. But we haven't done it to date. I'm skeptical. The one area of private equity I'm interested in is venture capital because that's really value creation proposition. But the fees are very high in private equity, and you got to justify those fees somehow. And I like old Ben Franklin. You said penny saved is penny earned. And you know, as there's a guy I like a lot at Stanford by the name of Ashby Monk, and he notes that you know, the information ratio on you know, a dollar saved in fees is you know, infinite, right? Because there's no variability in it, and when you're contrasting, people often say, well, look at all it really counts is after fee performance. Well, that's true. That's true. But when you're going into strategy, you're asking yourself, what's it going to do? What's it going to cost? The costs are pretty certain. What's it going to do? Pretty not certain. Okay? So you got to discount that expectation. Even if you think, well, this is a really smart manager, smarter than the rest of the guys out there that are making similar money, and that's a lot of money, we're going to go with them. We like them. They're the smartest. They're the best, most insightful. It's not certain. No matter how good they are, it's not certain. So you got to discount. In my view, rationally, you have to take your best guess and discount it for some because it's unknown. Compare that to the fees, which are pretty well known. You know, that's just the way I think about it. So we're fee sensitive, so we don't do private equity. Although someday, if we could do venture capital, I would like to do venture capital. We could find a way to do it that's not real expensive. But 2 and 20 and these kinds of fees, to me, are just too high. One of the other things Ashby Monk said, and I'll probably get the statistics a little bit wrong because I don't remember the exact date, but he points out looking at financial services, which is, you know, that's not only banks and, you know, investment companies, it's insurance and a whole lot, financial services. In the early to mid 90s, I think 6 to 7% of all U.S. profits were accountable to financial services. I'm guessing he's probably talking publicly traded companies because that's where you can get the data in easily, right? So you look at the Russell 3000 or something, or the S&P 500, and a certain number of share of those stocks are financial service stocks. And back in the early 90s, 6 to 7% of the pre-tax profits were attributable to that industry. What's that number today? That number today is about 40%. 40%. Somebody's getting overpaid.
Yeah.
Somebody's getting overpaid. That's just and I worked for investment firms for 10 years. My personal belief, I know this is being recorded, it's out there for the public to see, but my personal belief is somebody's getting overpaid. And I don't want to be the one that pays them. That's just my personal opinion. You guys can have a different opinion, but that's my opinion. So we haven't done private equity, we don't do hedge funds. So I think that there's some insightful things to be said about, you know, some of the things you can do with hedge funds. I think, for example, on the short side, there's a little bit more opportunity there. There's maybe some less efficiency in the short side. You don't have to do a hedge fund and pay 2 and 20 or 1.5 and 15 to get access to that short side of the market. You can do a 130-30 strategy, a partial short extension strategy, where they have the ability to borrow so they can short stocks. And we do that in a couple of our portfolios. We have 130-30 strategies. And you do pay more than a long-only strategy. You don't pay as much as 1.5 and 15 or 2 and 20. And so we don't do hedge funds. Not that we wouldn't someday. If the fees come in, we get more transparency. If the terms change, then maybe we will do them. But today, we haven't done them because I think they're too expensive, in my personal opinion. The board has reviewed that so far.
I agree with you.
So hopefully, any other questions at this point? Or? Okay. Okay, some of the things to consider when looking at the issue of outsourced CIO. You know, your internal resources. You know, whether you think you'll be getting better management, whether you think you can get better returns, better decision making, maybe more timely decision making. You know, well, I said, you know, most of our decisions here are like, you know, guiding a super tanker. You know, sometimes there are shorter term decisions, more tactical decisions to be made. Potentially, if you want to employ that. We at Sonoma County, we have an allocation called an opportunistic allocation. And that is 0 to 6%, and it's a range for a reason, 0 to 6% of assets. And we put this in place a few years ago, and the thinking was, if there is a real dislocation, as we saw in 2008, 2009, and there are opportunities that are outsized that are abnormal. Now, I'm generally the person that believes the market's pretty efficient. And so that's why we have a passive core, and that's the reason we don't do some of these things that are so expensive. They rely on a lot of inefficiency to justify the high fees. So I think the market's fairly efficient, though not perfectly efficient. And by that I mean, you know, in terms of the ability to capture those inefficiencies, right? Because there's a cost to capturing those inefficiencies. where was I going with this? Sometimes there are dislocations. There's big structural changes. So we created this opportunistic allocation. We said, if it's zero, that's fine. There's no opportunity. We haven't failed in some sense. But if there is an opportunity, we want a streamlined way of accessing that. And so a couple of years ago, we started using that for the first time. We invested in some funds that are investing in distressed credit in Europe. Basically, they're buying credits are being sold to the banks. So the new regulations, they're not that new anymore. The regulations that came out since 2008 in the U.S. and Europe are forcing the banks to clean up their balance sheet. Right, they're getting rid of a lot of these assets that are underperforming assets and whatnot. And the banks are doing it in Europe. Europe, they're behind the U.S., so it's taking them longer to clean up their balance sheet. As they do that, they sell off these large portfolios. They sell off big chunks, $200, $300 million at a time. And the argument is there are not many people that can buy a big portfolio like that and digest it. They're complicated, so there's like an opportunity, if you can understand it and digest it and analyze it, for those few who can do that, there's an opportunity there, an outsized opportunity. So we've actually been investing in funds that they're trying to do that with a firm dealing with Davidson Kempner. But we're investing with rollover funds. So the rollover funds, the way they work is this keeps your fees down. So again, back to fee sensitivity. We're paying, I think it's 70 basis points plus a preferred return of 8%. Over that is 10% preferred return to the general partner at the end of the life of so it's a closed-end fund. So you get your principal back plus your 8% in cash. You as investors and LP, you've got your money back plus 8% return, and then the manager gets a performance fee on returns above that. There's a lot of potential for conflicts of interest in this industry, and it's really hard to align interest perfectly. Performance fees don't always do that. They don't always, because they're complicated, and there are a lot of reasons for that. But that's a case where I think we've done a good job. They've done a good job of aligning their interest with ours. But being a rollover fund, what that means is they have these other funds. Let's say they buy a $200 million portfolio, and they put it into their hedge funds and private equity funds. There's only so much they can take for diversification reasons, so there might be some left over. If it's left over, it goes into this rollover fund. So you may not get your money called. They're only charging you on invested capital. So they don't call us. Big deal. It's cost us nothing. It's cost us the time to put the contract in place, I guess. The legal fees to evaluate the partnership agreement. And so with that, we pay lower fees, and that's attractive to us. So we're always looking for ways to do some things that are interesting and innovative, but are fee sensitive. So was there a question?
When you invest in these vulture capital funds that
I wouldn't call it vulture capital.
guys are going out and buying distressed debt. Do you or do other fund sponsors, do they monitor the way they do business? Because what I've seen, there are
Talking about ESG now.
There are good vultures, and there are truly evil vultures who have really taken terrible advantage of borrowers. They buy these large portfolios, and then they, at 25 cents on the dollar, and then they just screw the borrowers. And I think, I just wonder if any of the investors who invest in those funds are monitoring the behavior of those managers.
Well, the firm we're investing with has been doing it for a number of years, and
I'm not saying that they're good or bad.
Yeah, they've been vetted
but
by.
There are good ones and there are bad ones.
They've been vetted by our consultant, which is Aon Hewitt, and we've vetted them too. We've done on-site due diligence. We looked at a number of the deals and how they've added value with the deals, and I've never seen anything that, in my mind, was egregious like you're talking about. But sometimes these are underperforming loans, but if you buy it, it's only worth 60 cents a dollar. You buy it 40 cents a dollar. That's the way to add value, right? I mean, it's all in investing. It's always a matter of what's it worth and what are you paying, right? And so it ultimately comes back to that. So obviously there's restructuring involved in this. If they're underperforming loans, and that can be, sometimes businesses go out of business. I mean, that happens all the time, right? Businesses shutter their shops and they close up because they're not making a profit, and that does happen. And so maybe people have lost jobs, but I've never seen anything I've seen with this firm that's unethical. But anyways. Okay, so what do we got here? This is just sort of a depiction of the outsourced CIO model. You tend to the shared responsibility tend to be these things like strategy, investment policy, asset allocation, your big decisions. And to the right, some of these things that may be delegated, manager selection, strategy execution, rebalancing, these kinds of things. This slide is just making the point that your asset allocation is your really big decision that you have control over. I would add to that presumes you've diversified well, right? So when I was in college, I was an econ major. My advisor was a guy I love, Ernie Ankrum. He's a PhD economist from Oregon, and he went on, after he taught at PLU for a number of years from college, he went to Frank Russell Company, which used to be in Tacoma, and when he left, he retired from there. He was the chief investment strategist. So he's a very sophisticated guy. And I remember when I was at PG&E, we were a client of Frank Russell Consulting, and we were talking to him, and he said, "What are the first 3 rules of investing?" And he said, "The answer is diversification, diversification, diversification." So assuming you're well diversified, then the next most important decision is your asset allocation, certainly. So the right quote there, I think, just makes the point that sometimes you have to adjust it. So I sort of, I used to feel bad when we were changing our investment policy statement a couple times a year, but these are small changes usually. But I realized that one of our board members is an attorney, said, "Well, it's really a living document." And he's absolutely right. The corpus of our IPS, or investment policy statement, is absolutely stable. 90% of it doesn't change, 95% of it doesn't change. But you enter a new asset class like farmland, if you want to call it an asset class or a new strategy. Then you got to write some guidelines. You have to set up a benchmark. So that's something you add to the IPS. So it's always evolving a little bit, but the overall corpus is very, very stable. It hasn't changed since I've been there. This is sort of giving you the range of sort of fully discretionary to traditional advisory. We're probably more toward that traditional advisory. There's a hybrid model where you're outsourcing some of these responsibilities and not others. Extension of staff model where you have internal people doing things for you as well as external folks that you're consultant. We often refer to our consultant as an extension of our staff. James, how are we doing on time?
I think we're.
I mean, I can speed up, or however you'd like to manage that, or.
I think we're all enjoying this.
Okay. This is just sort of a checklist of things to think about. If you're delegating to an outside CIO, what are your strengths internally? I mean, there's no right answer to this. These are just considerations. Resources, expertise internally versus externally. What do you want to develop internally? Prioritizing the characteristics for your partnership. I mean, be explicit about it. Requirements for staff, and your expectation of benefits, from delegating. So, articulate exactly what you think you want to expect to accomplish with that delegation, and then measure, I guess, would be the implication. And then I'll talk, a little bit about how, we're organized at Sonoma County. And you've asked a lot of great questions, and I think I've probably shared some of this already, so I can skip over that. But the board's at the top, staff and consultant, we do consider, we only have 2 investment staff, at myself and Steve, and so we consider our consultant to be an extension of our staff, and we talk to them almost daily, right? They do a lot of research for us, they put together presentations for us, they make topical presentations. I consider us to be leading that effort, but they're definitely part of the team, and we enjoy working with them. And I think as much as the organization is important, and organizations do have cultures, the consulting organization you're contracted with, the individuals on the team are very, very important, because it's all about people. It's a judgment business. There's a lot of judgment involved, and you have to trust the people you're working with, and it's very, very important. And so you want to be comfortable with the working style of the individuals. Then at the bottom you have your managers, then of course you have people actually do a lot of this administration and custodian, but performance measurement, you have transition managers, you have prime brokers potentially. We have a prime broker for our 130/30, our partial short extension strategy. So a lot of those, those are all the day-to-day services that really don't get any glory, but they have to be done well, they have to be done right, they have to be done all the time, to make sure that you're not losing any assets are all accounted for, everything's reconciled. These are the things our board is doing, adopting the IPS guidelines, approving managers. Ultimately, we bring the way we work when we select a manager is we have a given space. We want to hire an infrastructure manager. We go to our consultant, say, who have you vetted? Who do you like? They give us a list. We talk with them. We collect details. Ultimately, we interview some finalists, and then consultant and staff together, based on consensus, will bring a single recommendation to our board and sort of an up or down vote by our board. That's how we go about selecting managers at Sonoma County today.
Your rate of return, expected rate of return.
Yeah, that's something that, is recommendation from our actuary and is adopted by our board. And our assumed rate of return today, for the actuarial purposes, is 7.25. I think yours is 7, is that right? Yeah. So. And you have the same, we can't be too far apart because you have the same CEGL as your actuaries. So. We work with the same folks there. Very good people. So these are the kinds of things that staff is doing. We do due diligence as well as our consultant. The consultant does sort of the upfront due diligence before we hire a manager. We're not going to look at a manager if they haven't done due diligence, and they can do a deeper level of due diligence than we do because they have the resources. So they can do, they can follow a dollar in a trade, make sure that they have the right back office programs in place, and can document all their trades and keep track of all that. And we're going in before we hire a manager. Periodically, after we've hired a manager, every 3 years we go on site to make sure that we're comfortable with the leadership of the firm, the direction of the firm, the research, the portfolio management team, the analysts, if they're analysts, depending on the traditional or quantitative firm, the investment process, business continuity, these kinds of things. So it's more of a top-down look than a bottom-up look. We spend a half a day with them. It's pretty detailed. So we work, hand in hand with our consultant and doing due diligence on our managers on an ongoing basis. Yes.
You mentioned that AUN has been your consultant for quite a while. Does the board have a policy on how often they look at replacing their consultant?
We agree. They don't have a schedule.
Year,
Yeah, they don't have a schedule. I think it's a little bit different because, as I said earlier, there's sort of philosophy of investing that, you want that to be stable. And I do consider our investment consulting firm an extension of our staff. So, but we did agree this year to do, sort of do a survey of the marketplace, who's paying for what and who's out there, who the significant consultants are, these kinds of things. So that we did that 4 or 5 years ago, sort of survey the marketplace. We talked to other investment officers at other California public plans, and so we know who the significant consultants are, and get an idea of what they're charging, the range of services they're providing, et cetera. So we can sort of compare them to the marketplace, but we don't do a formal RFP process.
How long have they been your consultant?
I think it's, I don't know exactly. It's probably in the around 15 years, something like that. Inniscanuck was a predecessor organization. Then Aon bought Hewitt Consulting, and they also bought Hewitt, and then right after that they bought Inniscanuck. So Inniscanuck was our consultant, and then it became Aon Hewitt. So 15 years ago it was Inniscanuck. I think it extends back that far. So,
Jim, can you talk about what you're looking for when you're conducting your survey
of a consultant.
Of a consultant? What is it that matters to you when you're choosing an investment consultant?
That's a good question. Well, your competency, breadth. We are doing real estate, so it used to be. There's been consolidation. Of course, that happens in every industry, and you see these over time. These periods of, people leave, create their own consulting firms, and then consolidate. And this sort of happens. It's happened multiple times in the industry. There's been a consolidation over recent years. There are a number of. Aon Hewitt is one of the bigger ones. They just recently bought Townsend, which is a big real estate consulting. Real assets, I guess, was real estate, and they also consult on infrastructure, farmland, probably timber. and now that's part of Aon Hewitt. Some bigger plans will have multiple consultants and have special consultants that have all consultants will consult on private equity and hedge funds. And hey, fortunately, we don't have to worry about that stuff. But we do need somebody to consult on real estate. And when we're looking at, the reality is we've looked, the private distressed credit strategy we're invested in. It's actually a series of funds. That is an alternative investment. So we need a consultant that has some expertise in alternatives, even though we're not doing a lot of alternatives of the nature of hedge funds and private equity. And Aon Hewitt has that capability. I think if you can be comfortable that a firm has good expertise in those other areas like real estate and alternatives, that it is cheaper to have one consulting firm rather than multiple consulting firms. From when we've done surveys, if you hire best of class and you have 3 or 4 different consultants, you tend to pay more than if you have one. You may believe that you're getting better service, and so that's the eye of the beholder. At our size, we're happy to have one that we think is pretty darn competent in all of those areas. Manager research is very important. I mean, I think that the asset allocation is probably not that different. When you do your asset liability modeling, there's a right way to do it, and there's less robust ways of doing it. I think Aon Hewitt does a very good job of that. They do our asset liability study every 3 years. We did one in 2017. But if you do it right, there are other people who can do it right as well. It's a matter of what assumptions do you build in, and how robust, and do you have fat tails to your distributions, these kinds of things. You want to make sure they can do, if you're going to use them for your asset liability studies, you want to make sure they can do that well, but there are a number that can do that well. Manager research can be a differentiating, skill set, and they want to make sure they're doing, if you're going to do active management, they have deep active management research capabilities, and have good pool of managers they've fully vetted, and you're comfortable with that process. And then there's sort of the philosophy of investing, as you say, which is characterized by both the firm as well as the individuals working on your accounts. So that's you're thinking, not only what firm am I hiring and the philosophy of that firm, but also the individuals that you're going to be working with directly, your line consultant. I think that's very important because there can be variation. But there are philosophies that are that span the organization. And as I said earlier, we're fee sensitive. We've been reluctant to go into alternatives, although I would consider, you could call farmland and infrastructure alternatives. You could call our partial short extension strategies alternatives. You could call our distressed credit strategies that we're using in our opportunistic allocation alternative. Yet we're not doing the more expensive alternatives. And some consultants might push harder on some of those alternatives. And if you didn't want to do that, you might not want to hire those consultants. We'd be pushing harder to do those things. They may do it in all good faith. They may really believe you're going to get extra return from private equity. You really should do it. But if you don't believe that, then maybe they're not the right firm. There's not an alignment of philosophy. So those are things I would think about. Was that responsive to your?
Yeah. Are there things that you would consider disqualifiers?
Well, that's a good question. We used to, and I remember a dear man that was on our board for 35 years, Alice, just a great guy and great contributor to the board. And he used to, think it was important to have independence. He wanted a consulting firm that did just consulting. And I agree that is the ideal if you can find it. The trouble is now it's hard to find a consultant today that doesn't do anything but consulting. Mm-hmm. That's just the reality. So Aon Hewitt is, it's a big insurance company, Aon is, and so they have this division that does consulting. Now, hopefully they have, a proverbial Chinese wall between that part of the organization and the other parts of the organization, so they're not trying to cross-sell you, and there's not a conflict of interest, they're not pushing something that makes them profits in another part of the business. Those are things you have to worry about. So ideally you wouldn't have that conflict, but it's hard to find, Frank Russell Company is a premier consulting firm, yet now they're a big investment firm, and that's where they make all their money, right? They don't make their money in consulting, they make it on managing assets. We all know that. So, if you thought there were ethical issues, like they had other parts of the business and there wasn't a good wall, to protect the consulting business so it's objective, then that would be, in my view, a no-go. If you thought for whatever reason that this was an unethical organization, because at the end of the day, it's about trust, right? When you hire managers, it's about trust. You're giving them discretion over, who knows, millions, tens of millions, hundreds of millions of dollars of assets. You better trust them. If you don't trust them, do not hire them. And the same goes for a consultant. And that's a judgment call, right? You may trust somebody that I don't trust, and vice versa. So that's in your best judgment, do you trust them? And you decide whether you trust them by doing your own due diligence on them. You're vetting them. You're going on site, talking to their staff. You're looking at their processes for evaluating managers, how robust is their asset liability modeling, these kinds of things. And then ultimately, in the day, it's sort of the gut check. Do I feel this is an honorable firm that's going to do right by us and our members? Good questions. Yeah. So those are the things that staff is doing, and then there's some things that our consultant is doing. That's how we do it at Sonoma. But managers, administration, list of sort of the service providers. We have State Street's our custodian. We work with. We have it's like an octopus. We have a lot of tentacles that touch on us. From State Street, Securities Finance does our securities lending. We do. We have a transition management service we've used at State Street Global Markets, a division of State Street Bank and Trust. But we also this last year, we not because of any concern about State Street transition management, because we felt best practice was now to have a pool of transition managers you could select from and pick the one that we think will do the best job given the specific kind of transition we might have at the time. We went to a pool of transition managers. We hired.
What's a transition mean?
So transition manager is a good question. Sorry, I didn't explain it. A transition manager will, as an example, move assets from one place to another. So if you fire a manager, want to hire a new manager, maybe the new manager will take some of the assets from the old manager, but they probably won't take them all because they're going to want a different portfolio. But that transition manager will manage selling off some of the assets, moving the assets they want to keep over to the new manager, as an example. But that transition process.
Oversees an orderly transition.
And they'll do what they can to minimize, so sometimes if, they have a big book of business, they're doing this for other people, and they'll be able to cross. So if you're selling stock A and somebody else is buying stock A, then they can do that without having to go to the marketplace and avoid brokerage fees and market impact. So, so part of it will be crossed, and then some of it will have to be traded in the open market.
Yes, and what is securities lending? How does that work into it?
Okay, let me address that just to finish. That applies when you have direct, separately managed accounts. Right? If you're in commingled funds, you're not generally going to use a transition manager. So, I don't know. You may be mostly commingled funds at your size, so you may have less need for a transition manager. So, okay, your question was securities lending.
Mm-hmm.
Okay, so you want me to explain what it is first, or you know what it is?
Yeah, I don't know.
Okay, so securities lending is, your custodian holds the assets. The managers in a separately managed account are deciding which securities to hold and in what proportions. But the custodian holds them. Well, the manager, most of the securities are going to be there for weeks, months, maybe even a year or two, or even longer. And so there are people, brokers, that want to borrow those securities for short periods of time, and maybe 30 days, maybe less. And they will pay you to borrow those securities. Now you want to make sure you get your security back because manager A owns Facebook for a reason, and they want to keep holding Facebook, and you want to maintain economic exposure to Facebook. So what your lending agent does, and we have State Street as our lending agent, it could be a third party. They will lend to a broker, Facebook. Facebook then gives them collateral, and usually if it's domestic stock, I think it's 102%. So if the Facebook stock is worth 100, they're going to get 102 back in collateral. It may be cash, it may be treasuries. You could even these days be stock. If it's stock, it may be 108% of the values would be 108 instead of 100. And then if it's cash or cash equivalent, it can be invested in the fund. At the end of that loan period, we return the collateral with interest, and they return the security. The security comes. You've earned a return on the collateral you held, and that's yours to keep. You owe them a credited rate, which is the return on their collateral, and that's going to be lower than the return you've earned. That difference, that spread, is how you make money in the program. Okay, so some people will take a lot of risk with the investment at collateral, and we don't want to do that at Sonoma. We take very little risk with that, so it's very invested very safely. But that spread is where you make your money, and that spread then is shared usually with the lending agent because you're paying them for facilitating and managing all this. They'll take a split, like they'll take 30%, you'll keep 70% or something like that. That's our split today, is 30-70. It makes us a few $100,000 a year. And there's very little risk because you have the collateral, and the lending agent, in this case our custodian, they know who they're lending to, they manage who they're lending to, they appraise who they're lending to, they've got the collateral, and then they also provide a guarantee in the case of non-performance by the borrower. So the borrower didn't cough up the securities at the end. State Street, in our case, would be on the hook. And that's generally the case, that the lending agent provides guarantee for the non-performance of the borrower. So
why do they need to borrow that stock in the first place?
Well, sometimes it's the
Getting up into the weeds.
it's the other side of. I mean, this is where you get into the murky, complicated kind of stuff, right? and it's you got to be in the industry to know all the terminology and whatnot. But one example is you want to short the stock. So if you want to be short a stock, you have to borrow it. Okay, so in our 130-30 strategy with Jacobs Lead, their quant manager, right? They're running against the Russell 3000 for a period of years. We had them running a long-only portfolio. They would buy stocks they liked, didn't buy stocks they didn't like. But the rationale for 130-30 is that it frees up the long-only constraint. So if you buy, if you can only buy long the stock, long is just when you hold the stock, like we all think of, that's normal investing. You buy a stock you like. Well, if you're running against the benchmark, you want to buy more than the benchmark, right? If Microsoft is 3% in the index, you want to own it at 4%. If you like it, you want to own it at 4%. If you dislike it, you might still own it. You might own it at 2% or 1%, right? Because you're underweight relative to the benchmark, and if you're right, you add value with that. What if the stock is 50 basis points? It's 0.5% of the benchmark. You really don't like it. Well, you can not own it. Now you're 50 basis point underweight. That's as much as you can underweight that stock. Well, what if you want to underweight it more than that? Well, if you can short it, you can underweight it more than that. So when you short it, you are going to borrow a stock and sell it, and then you at a later date agree to return the stock, and you buy it at the current market price at that time. So if the market price goes down, then you're buying at a lower price to return it, and you've made money. If it goes up, you lost money. So it's just the reverse of long investing and short investing. You have to borrow it to be able to short a stock. That makes sense?
Thank you very much.
Thanks.
It gets quite, all the details get quite complicated, and you have to sort of be in the weeds to really fully, to know all the terminology and all this kind of
Second
stuff.
semester stuff.
Watch Big Short, watch The Big Short.
Did experience with other funds, did you guys experience any investment losses in your sec lending reinvestment portfolio in 2007?
It's a good question.
I know it's kind of way
No,
down.
I'm happy to address it because I'm actually proud to say we didn't. Now, but we're getting in the weeds here. Okay.
I know, sorry.
Okay, but I mean, if you want to listen to it, I'm happy to explain. But I don't want to.
You've answered my question.
Bore you to tears. But we had separate account sec lending and commingled fund sec lending, right? So we have our index funds or commingled funds because that's an issue of scale, right? Even if you've got 500 million, you probably are still going to, and you want to invest it passively, you're probably going to invest in a fund that's billions and billions, right? There's just economies of scale to that. So we have our index funds with State Street, and they have sleeves that are sec lending and sec lending. We chose to invest in sec lending sleeves. Now, when you do that, they decide how they invest the collateral. In a separate account, we decide how we invest the collateral. So in the separate account, we chose a very conservative fund, no problems, in 2009, 2010, after the 2008 blow. In the commingled funds, where they decide what pool to invest it in, there was an issue. It didn't result in a loss, but they had some longer dated securities, which because they were longer dated, they were written down. And while they thought they would be good in the long run, which they did prove to be good in the long run, in the short run they were marked down. They pulled down gates so they wouldn't let us take all of our money out. So we had, a couple $100 million or something in these index funds. They said, well, you can't take it all out. They had the authority, based on the documents, to say you can't pull it all out tomorrow. And they sort of put down these gates and sort of made you pull out over time if you wanted to. Well, we didn't have any reason to pull it out. We didn't like the illiquidity. We still want to maintain the index fund exposure, so we did. And after a few quarters, I think it may have been like 6 quarters or something, they finally said, look, we think these securities are good in the long run, and I think this is really a statement about State Street's integrity. And I know they've been in the news for some negative things, but they really were very outstanding in this case. They said, we're gonna put, I think they put in $250 million or something of bank capital, so stockholder assets, into the fund to make the collateral pool whole. So then they took the gates up and people could withdraw their funds if they wanted to. And then later, when those securities rebounded, there was actually a gain in the collateral funds. They never took that back. They didn't. So that was just sort of a gift from the bank to the members that were participating in those collateral pools. So there was a period of illiquidity that we experienced because of that. And now those collateral pools, they manage more conservatively, and that's something we watch carefully. And if they were at some point, we would ask this question, might you ever someday manage them more aggressively? And they might 10 years from now. And if they do, hopefully, if I'm still around, I'm going to be watching and saying, we may stop our SEC lending through those commingled funds. But in our separate account SEC lending, we invest the collateral. We don't want to make money by taking risk with that collateral. We want to make money just by simply lending the security. And there's some business in that, just providing the convenience of especially hard to borrow securities. There's some money in that. It's only, $200,000, $300,000, $400,000 a year. It's not huge, but it's something. It's not zero. It's,
Subprime's back already?
So that's our SEC lending programs. Any other? I think that's really all I had to say. And, it's interesting that I had this chart that I know Jeff's seen this before at Sonoma County. We were created in 1946, I think, 45 or 46, and it shows the evolution from left to right of our investment program. And back in the early days, it was all bonds. And literally, I have this chart. Actually, I brought it in my truck, forgot to bring it in. But it's this long scroll, and it's individual bonds that our board members, like Al Also, I mentioned, who was on our board for 35 years. They were selecting individual bonds to buy and hold in the plan. And, somebody was clipping coupons. And that was the early days, And then, and I think it was 84, early 80s, they allowed stocks to be included in the asset mix. And so then it went from all bonds and, to, I think early 80 or so, we actually selected a third party, manager to manage a portfolio of bonds for us rather than managing ourselves and selecting ourselves. And then we added stocks and then asset allocation, and now 130/30 partial short extensions, and we have some overlay programs. One is an equity insurance risk premium strategy. I mean, it's just gotten complex, and but still for the most part, the bulk of investing is really just you're a lender or you're an owner. But it's an interesting chart to look at because it's all one color, all bonds to the left. 1946, and then as you move to the right, it becomes multifaceted and much more complex. But.
Are you fully funded?
No.
Not
is
how-
anybody fully? I mean, there are a few. I think
was going to be
Fresno-
polite, that's
Fresno
why I
is.
asked it that way.
We're
So what is
we're 86% based on the end of 2016. So
And the size of your unfunded then is,
Fresno City.
I don't know the number. Yeah.
Fresno
Did
City.
you know Don Head?
I know the name.
He was on your board.
Yeah, for prior, well before me. Yeah. But or Al would have known, of course. But I don't know him personally.
Chris Ailman, do you know him?
Oh yeah, because when I worked at he's at Teachers, of course, STIRS, and he was at Sacramento years ago, and
Way before Stirs, yeah.
yeah, when I worked at Zurich Scudder, they were a client. STIRS was a client, so I met him in that capacity as a client. I was a relationship manager. So.
Question. I'm not sure if you're aware of what are all the differences between the Sonoma County plan and the Mendocino County plan, but are there some big ticket items? I mean, I know the things that I've heard is that there's never been, I think, a COLA for retirees in the Sonoma County plan. Are there some other?
That's not exactly true. It's true that we do not have a built-in COLA, and Jeff can speak to this probably better than I can, but there's no automatic COLA, and it's considered to be a discretionary COLA, which is allowed for in the 37 Act. I've been looking over to Jeff. Tell me when I say something wrong. So it's been a number of years since we gave the last COLA, because if we have reserves, we keep track of those. Those reserves are negative today because of 08, and we've been recovering since then. But the fact that we're not 100% funded obviously communicates that we're not. Those reserves, if we outperform for a period of years, and you can build up those reserves, then have positive balance in the reserves, and then at some point we could give a COLA theoretically. Although I think that it's agreed now by our current actuary, and I think as a finance guy that it's true that it's not a good design for a COLA, because it assumes if your assumed rate of return is your best guess is what your return is going to be in the long run, then you never really have an overage, an excess, because sometimes you're going to outperform, sometimes you're going to underperform that assumed rate of return, and that's just variability in the market. That doesn't mean you have, if you have some good years, better watch out, because you're probably going to have some bad years, and that you shouldn't just be giving that out in the form of COLA, because you're going to need that to cover the bad years. Unless for some reason your 7.25% assumed rate of return was not your best guess. Your best guess was 8. Well, then you got 3.75% to deal with there on the long run, right? But the 7.25% is your best guess over the long run. So I don't think there is ever going to be a reserve. So I think we have to redesign the plan if we're ever going to have a COLA. But we have given COLAs, but the last one was a number of years ago. I think it was 2008. Is that right? Because we had performed well up to then. And so in that year, it was either 7 or 8, because it was right when I first came to the county in 2007. I think it was 2008. The market had dropped, but we still had some large reserves because of the performance of the prior years. And they said, well, we can give a COLA. They gave a COLA. And that's the last year since then. Then the losses rolled through over the following years. And then we started rethought it and thought, and people like me have always said, there really never is an excess.
So that's my question. You're calling it reserves. Is it really excess earnings they were counting?
Well, they keep track of it in these sort of buckets, but it's conceptually, when you earn more than the
Right.
assumed rate of return, over time you can build up a balance in there.
Do you know if either you or your advisor actually sets a rate, like our investment advisor does a 10-year rate of like 6.6 or whatever it was, 6.4 or something
Their
like that?
expectation.
Yeah.
Their capital market forecasts.
Yeah. Does yours do that?
Our consultant has an estimate for those things. They're just estimates.
And are you curious what yours might be in relation to your assumption rate?
Yeah, I think it's not too far off. We would look at that when we do an asset liability study. And when we do, we're always looking at that. And I think that our actuary, which is the same as your actuary, I think they do a survey of consultants. So Aon Hewitt would be one of those many consultants they would look to get an idea of where do you think returns would be for major asset classes over the next 30 years. And they develop something.
And ours does 10.
And yours is a 10-year?
Our advisor does a 10-year.
Yeah, ours does a 10 and a 30-year. Yeah. And they're not too far off. Not too far off.
Do your retirees have access to a health benefit at all? Health insurance?
They get an allocation amount that's to be, they can use for healthcare. Is it $500 a month, something like that? And then they get access to the pool cost of the premium, right? So that's, I think the bigger benefit is that, when if I was to retire tomorrow and I was to, get my medical care through Kaiser, which I currently do as an active employee, I would pay a premium. So, I'd be pooled and paying the premium that an active employee would be paying, I believe. Is that right? Is that right, Jeff? Yeah. And so that's to me, that's the bigger benefit is, because reality is actuarially you're more expensive as you get older, right? And I'm more expensive now than I was 20 years ago. So that's the real benefit.
Until Medicare kicks in.
Yeah.
And you're over the goal.
So, Well, thanks for the time. I enjoyed the time.
Thank you.
Thanks so much.
Pleasure.
It's good to know we're not that far off.
I was just glancing at your asset allocation. It looked not too dissimilar from ours.
Yeah.
I mean, you're not in, and maybe it's just the size of your plan difference. You're not in farmland, and but you're in real estate.
Mhm.
So there's your real asset exposure, and you're not in infrastructure. Those are things we just, infrastructure we just did recently this last year, 2017. So really, in my view, most of that is, that's just further diversification. It's not really changing, it's not a major change in the complexion of our asset allocation, to add those things. It's on the margin, and if you do depends on the assumptions, we model all that stuff, and the enhancements that we're getting from going into farmland, going into infrastructure, they're quite modest, and they're based on the assumptions. So, I'm glad we're doing them, but just to say that we're really actually the big levers, stocks and bonds we talked about earlier, we're not too dissimilar. Yeah. So,
Thank you so much.
Okay.
Thank you.
Yeah,
Thank you.
My pleasure.
Okay, we're going to take a 10-minute break.
Yeah.
Resume the board meeting.
I hope everyone got some good value out of Jim's presentation. Really,
Very much so.
the setup there was, we have it on the work plan to do the RFP for investment consulting services later this year. I wanted him to come in and talk about the bigger picture of investment management and how the consultant fits into that. And hopefully all of that discussion gave you a better understanding and background of what consultants do and what they can do, and some things we can look at and think about.
So just when you said outsourcing the CI, you weren't talking about us having any relationship with Sonoma County, though.
No, there's a model in the investment consulting landscape that's been developed called outsourced CIO model, where essentially you contract with an organization and they can do as much as everything in the investment space for you, building your investment policy statement, taking care of asset allocation, actually managing and custodying assets. They do it all and just report back to you. Or that's kind of at the very far end of the spectrum. And then at the other end of the spectrum is, having consultants rather than on a retainer basis, just a project basis, where you don't really have a full-time consultant. So there's a broad spectrum of service models in the investment consulting space. Outsourced CIO is kind of the latest hot topic in the investment consulting world, and there are a lot of people talking about that and have been moving to that, and it's truly just an outsource of everything. I wouldn't recommend that for us, but I thought it'd be important for the board to hear about that as an option for us. So, but not Sonoma County. It's a private firm that runs everything for you.
So we're going to go ahead with the RFP for consulting services, but following what he's saying, we don't necessarily have to leave our current consultant.
No.
And I thought it was interesting, he thinks they've been with theirs for 15 years, which is, I think you develop a relationship with people and they understand you and you understand them. And I think that's more important than saying, 5 years, we gotta get rid of you and we're gonna get somebody else.
Right. Okay, turning to the monthly investment report, you can see that, and this is reporting for the month of March. Again, the market had a great deal of volatility. Net investment changes were to the tune of $5.5 million to the negative for us. And that was spread largely across the equity space. Fixed income was up, albeit marginally, in the month of March. Looking at the returns for the month, we had a negative 1.06 rate of return versus the benchmark of 1.05. Longer term numbers still look good. That's the extent of what I thought we needed to discuss here, but I'd be happy to try to answer any questions.
So then we go on to the agenda item 5, which is the illustration of employer contribution rates, sort of stress testing.
Thank you, Mr. Chairman. Trustees, you have a letter from Siegel with the results of their stress testing. That not everyone's a fan of the term stress testing, and I was going to pull up the charts here so that we could look through those on the big picture. I'm going to assume that everyone's read the letter and looked at the charts, but I really wanted to just focus on the pictures. And because of the differences in scenario 5 versus scenario 1 through 4, they're put in two different charts. They're totally different. Scenarios 1 through 4 are looking at an investment performance that's different than our assumption, our current assumptions of 7% rate of return and 3% inflation. Scenario 5 looks at changing the assumptions, so it's totally different than the first 4 scenarios, so they're represented differently. You can see here we have Exhibit 1A looks at the employer contribution rates under the different scenarios. The baseline is the black. You can see that if we match all of our actuarial assumptions over the future, we're expecting contributions to trend down over time. And you can see here we have in 2032, we have a roll-off of our 18-year layer at that point of a significant change. And this relates to, I believe it's the unfunded liability increase when we lowered our rate of return assumption from, I think that's when we went from 7 3/4 to 7 1/4. And then we get another reduction 3 years later. I think that's when we go from 7 1/4 down to 7. And then the big drop at the very end in 2039 is when the original layer of the $100 million that we amortized over 30 years beginning in 2030 and in 2009 rolls off. Then we end up down here at just a normal cost rate, which interestingly, once we're just paying normal cost out in 2039, our employer rate's only 8.4%. So
Then they'll fix the roads.
We'll start paving what will then be gravel roads.
We're re-graveling the roads.
Yeah.
Jay, do you know why they used a -20 on 2018-19?
that's what I told them to.
You think we're gonna have a -20?
No,
Okay.
no, I don't. No. In the first page of the letter is the scenarios that we gave them. So we had talked about this at a board meeting several months ago, and I proposed a list of scenarios, and it was these 4. And it's really intended to look at kind of best case scenarios and worst case scenarios, what could happen. And comparing that to what we actually expect. The scenario, so in scenario 1, we experience a 0% rate of return in 17-18 and then return to 7% every year thereafter. Scenario 2, we get 14% in 17-18 and then return to 17 forever. So those two really are a plus or minus 7 from our assumption. So either 0 times or 2 times our assumption. And that's the purple line versus the green line there. And you can see how closely those mirror in shape largely until you get towards the end, the shape of the black line. And then scenario 3 is really kind of the nightmare scenario, if you will, where we get a negative 20% in 1819, and then there is never a recovery. We only return to 7%. And in that kind of scenario, our average employer contribution rate gets to 50%.
Yeah.
But because it's smoothing, it takes that length of time to
It
get
does take that. It does take 5 years to get there because of the asset smoothing. So, and there is a non-zero probability of some event like this happening where we get a negative 20% with no real recovery. But there's a whole lot of zeros in that probability, I think. It's not very. When we get we've seen it after the 8-9 market losses where we lost 20%. We've had significant recovery in the years after that. I would say the red line is a highly unlikely scenario, but that is kind of what I think of as the 99.9 percentile absolute bad thing that could happen. So, and then we have and then the scenario 4 is we underperform our target rate for the next 9 years by 2 percentage points, and then only come back up to 7%. And you can see that the contribution rates do tend up, and they go north of 40%. But it does take quite a bit of time, and that's because of the 5-year asset smoothing, and it's not a one-time hit. But it does tick up over time. And it gets expensive.
Is there, maybe I missed it, probably did, there's a breakout between employer and employee contribution, or is it just?
This is just looking at the employer contribution.
Yeah.
And the reason we ignore the employee contribution, because the only thing that will change the employee contribution is actuarial assumptions.
Uh-huh.
So,
Okay.
because the employee contributions are driven by the normal costs,
Yeah.
and all of these changes that we're talking about affect the unfunded liability. Which leads me to the next. Oh, nope. This is the other scenario where we actually implement different assumptions. So we reduce the inflation assumption by 25 basis points here, from 3% down to 2.75%. And we reduce the investment return assumption from 7% down to 6.5%. And you can see that there is about a 3 percentage point increase in the employer contribution rates.
So now, what would happen if the county has this money that's in the pension gap reserve, where it's unable to earn much return because it's in the heavily regulated
1%.
okay 1%.
Woo.
So it's up from 0.25% a few years ago. But for regulatory reasons, it can't earn much money. And so what would happen if those funds, which is, I don't know how much is in there right now.
Is it over 4 or 3.5, 4 million, something like that? Or maybe more. Right?
Yeah. I know if it were to put that money into the fund, so that's one question. And the other is, what if for, let's say, the next 3 years, the county, or next 5 years, the county tried, if it could, put money into the retirement fund as if the plan was set at this 6.5% scenario, even though the board has not adopted that. So if the fund actually does earn the 7, or it's to the good. So how would that affect?
And I have another question to add as a third one on that. Our pension obligation bonds are going to be paid off in 2026, which will be $8 million, but apparently about $4 million to the general fund. And I could totally see the board at that time saying that's gonna continue to go towards retirement. I mean, Dan would know better than me, but I could see that heading where let's take that 4 million of general fund dollars and let's put that all in retirement. So that would be a third question on top of Dan's too.
Well, the answer to all three of those questions is it depends.
Good answer.
And it depends on a number of things. So if the county just sent us some money unexpectedly, we're going to give you some extra money. What our policies today would lead us to do is recognize that as a one-time unexpected decrease in the unfunded liability, and we would treat that like any other change in our unfunded liability, and we would amortize that over an 18-year schedule. So it would get added to the layer for that year's change in unfunded liability and amortized over 18 years. It would then, because it's amortized over 18 years, it would change the county's contribution rate by a few basis points over that 18-year period. And so there's not a lot of benefit for the county of doing that right now in terms of what it means overall. I mean, we've got a $200 million unfunded liability. If the county gave us, say, it was $5 million, because we amortize that over 18 years, it doesn't really move the needle on that $200 million. Okay? And that's our actuarial policies of how we handle something like this. The alternative is we could consider structuring an account held on behalf of the county within our accounting system and structure for those excess monies that the county wanted to contribute to us, that would not be amortized, but would sort of be to the benefit of the county and could grow in assets, but don't change the contribution rates. And we'd have to think through very carefully how to create that account and structure everything. And then there's the accounting side of it that we have to worry about as well. There's a lot more administrative setup and work to do that. I think it could be done, but we'd have to do some work and some research to get there. So those are the options that are available to us as far as I'm aware at this point. And I will confess I'm operating from memory here, having looked at this several years ago and having some discussions with the administration at the county about it as to what we could do. We would definitely want to engage further with our actuary and make sure we understand all of the issues at play here and set something up that works for everyone involved if we wanted to do that. So those are the options that I'm aware that we have at this point. There may be others, but I'm not sure.
Why an 18-year amortization rather than just smooth 5 years? Or
That's our policy. Our policy is that we amortize any changes in the unfunded liability in a given year over 18 years. So it's the 18-year layering approach. The reason this board, and this was prior to my time here, my understanding is that the board chose 18 years as the amortization length because that avoids the negative amortization that you get with a longer period.
That's exactly it. Yeah.
But there's some that are at different levels because
Some are 5.
depending on how it
Right.
comes.
But couldn't we change that? Because we have some that are 5. We have a couple things that are 5 and a couple things that are 18.
Correct.
Yeah.
And I think there may even be one that's 15.
But even if we change, is there a way we could change one-time payments, payments to 5?
It's just a policy.
Yeah,
The board
I mean, it
can change
almost
anything
feels
they
like
want.
if we want to, that, because I think Dan brings up a good
Yeah.
point. This has been a discussion going on for, 3 or 4 years now? about what's gonna happen with that pension gap reserve. And we have other issues coming down the road, I think with the payoff of the pension obligation bonds, because I do think I could totally see the board saying, worth putting that back into retirement. I mean, I don't know, but that's up to the board, but I could totally see that.
To the question of, could the board change the policy? I would say absolutely.
Yeah.
It's your policy, you own it, you can change it any way you want. At this point, I don't know all of the issues around it and would definitely want to do some research before we consider that and bring a proposal to the board.
Yeah,
So-
and I'm not sure too, when that was set up, was part of that to help pay our annual cost? Is that why that pension gap? I mean, is that kind of like a little reserve fund in case the county struggled paying their annual cost?
So I think it gets back even more to that second option that James talked about, which sounds like more work needs to be done to pursue that. But I think the concept was, if there was this extra money in the fund that was in the county's name because it's from the county for the unfunded liability, but if there was this bad scenario that occurred where the economy took another nosedive, there was less revenues coming in, there's a squeeze again, that the county is able to buffer its increased contributions to the retirement fund because there's this other money in the fund. I think that was part of the idea. But then there were also, I would call, salespeople that came to the county and said, we can set up a fund for you at this fee. And I'm not sure that was the best option, and the county never did pull the trigger on that, and so it's been sitting in the treasury.
The
PARS, it was PARS, I
Yeah.
think. Yeah.
just one advantage that there's a lot of things to think about from the county's perspective, and I'm not going to speak for the county, but having worked as a plan sponsor, I can easily see that managing that with an outside group like that, there is an advantage in that the sponsor still controls the funds. Once the money comes into the trust, the sponsor has no control over the funds any longer. It's now a part of the trust. If the county were to take this money and put it into a fund created by an outside entity, they may call it a pension reserve fund or a pension gap fund or whatever they want, but it's still the county's money and they can do with it whatever they feel they need to.
But they're making a higher percentage. They're not tied to the fixed income like the treasury. So that's the difference, is that
Once the money comes into MSERA, county can't touch it anymore. It's an irrevocable payment, if you will. I'm not saying that's good or bad. That's one issue that the sponsor would have to think through. Is there value? And some would argue that there's value in making it irrevocable. And I get that argument. So,
Well, the obligations to the pension fund are irrevocable, so it's
And part of the problem too, when there was the company that would do that, is you had to come up with, I forget what it was, $1 million or $1.5 million, and we didn't have any. We didn't have any money, and so that was another issue. Was, I think, in kind of getting that even created, the thought behind that was if we wanted to go in that kind of a direction, we need to have some money to buy. You have to buy into that kind of a setup. So, but I think that it does need to be, really it's the county that needs to, and I know they've looked at it over the years, but probably something that needs to have a little more time spent on it.
okay, Tim had
Yeah, this doesn't have a lot to do with us, has more to do with the county, and the pension obligation bonds, and when they pay it off and still sending the money to the retirement system. When the departments that are grant funded get a bill for contribution to retirement, it includes the normal cost, the unfunded liability, and a portion of the pension obligation bonds. They get a combination of those two things. They're grant funded, sometimes 80% of the salary and benefits come from Sacramento and Washington. When the pension obligation bonds go, they're not going to be able to bill these grant funding departments for that additional contribution goes away. And I don't think the county's gonna be able to just make up a number that we're gonna continue to bill these grant-funded departments, because you gotta justify what you're billing them. And I don't know that the county's gonna continue to bill that money out to grant-funding departments to help them pay for it, and then give the money to us. It's, I think a long-term scenario has to be considered of how, if they want to continue to pay down our unfunded liability with what used to go to pension obligation bonds, they got to figure out how they're going to bill the grant funding departments, or it's all going to come out of our roads. Basically, you asked about fixing roads, because I think the former CEO said 50% of the contributions come from grant funding operations, and the 50% comes from the general fund.
That's what I heard, the $8 million payment, half of that was the general fund. That's what I heard.
So if that goes away, I don't know how they're gonna get the funding departments to pay it.
Patrick, you
Yeah, I did have a question just regarding I think 3 or 4 months ago, we saw proposed legislation or pending legislation about counties' abilities to place money into retirement, their retirement system. In excess. I was just wondering if that legislation has any impact.
I'm just flipping through right here. I think it was enacted, and
So
I think it's talking about the issue that you're raising, and it allows that to happen. I'm doing it from memory. I'm trying to flip through it. It's in our agenda, actually.
Well, that's pending legislation, I think.
And I think San Mateo does do it. San Mateo County does do that, pay extra money. I've heard that. I don't know if that's true or not.
yeah, this wasn't. Yeah, I don't think this is in the materials today. This was several months ago. I think.
But
Something about prepayment?
Yeah.
Yeah, but do they have the option of determining whether it is prepayment or whether it's billing the unfunded liability? I guess what I was trying to figure out is, does the county unilaterally decide how the money is placed? Is that what that bill gives them the right to do? That's what I wasn't clear on.
I don't know.
Okay.
That's the best answer I can give you right now. I have a vague recollection of us talking about something about prepayment at some point in the past, but the details are very sketchy in my mind. But I know there was some piece of legislation or potential legislation or something looking at prepayment options. I'm not entirely sure.
Okay.
Well, there has been a law that allowed that going on forever. We looked into it when I was in the auditor's office.
A long time.
That's a long time ago. And if you get a discounted, the county gets a discount because they're giving the money up front.
May get a discount.
Yeah, I'm not sure if it is, should or can or must.
It's not required, is my understanding, but there'll be a discount. So, okay, so jumping back here, you can see so the 3% increase in the employer contribution rates. It's also noteworthy that out at 2039, when we're just down to normal cost, because of the changes in assumptions, that there's a 70 basis point difference in the normal cost because of the lower rate of return and the lower inflation assumption. So that's just something I wanted to point out there. And then looking at the unfunded liability and the funded ratios, facing a 20% down. I know everyone's focusing on the red line. Yes, I see it. The unfunded liability gets to $343 million with a 20% loss, which is north of $100 million for us at this point. And then no real recovery after that. So it's bad. But the much more realistic scenarios, we're looking at an unfunded liability increasing from 204 million, moving in the vicinity of, say, 180, 160 to 220 ballpark in the next 5 years. And the blue line is we underperform by 200 basis points for the next 9 years, and then we come back to just 7%, the unfunded liability tops out at, what is that, 248 million or so? 246? And eventually they all still move in the direction of zero. Of course, all of those have these increases, or the decrease for the one good scenario, have increases in contribution rates required to get us moving back towards a zero unfunded liability. And these two scenarios, the scenario 3 and scenario 4, do end up at zero. It just takes a little bit longer because of the 18-year amortization and the smoothing lag with the changes in the unfunded liability. So, but they do get there. And then you can see if we had changed our assumptions in 2017 to 6.5% and a 2.75% inflation, there would have been an extra 20 million in our UAL in 2017, and the two lines converge right around in 2034. So at that point they're the same, and that's when the 18 years would roll off from the 2017 change.
So this-
If we had gone with the orange line rather than the black line. So,
Jeff found something very interesting.
So, this has been enacted as of July of 2017. It says this bill would specify that the authority to make advance payments described above does not prevent the Board of Supervisors or governing body of a district from making advance payments for the estimated annual county or district contributions for an additional year or partial year if certain requirements are satisfied. And it talks about the current law applying to San Bernardino. So let me do a little digging on this, because I thought that there was something that was enacted, and I think we had made, probably back in July of last year, traded some emails on this issue. So there may be some vehicle, a new vehicle that allows what you're talking about.
so I just want to remind the board that these graphics, there's nothing actionable in these. This was purely educational and informational for us. I do think one of the things that we could carry to the administration of our plan sponsors is be thinking about and looking towards our next experience study, which will be in 2020. There could be a further reduction in our assumed rate of return proposed by the actuary, and a reduction in the inflation rate proposed by the actuary. If that were to happen at that point, you could be looking at a 3 percentage point increase in the contribution rates on average. So that's just there's a whole lot of qualifiers in that statement. If, then this could happen. But I think it's good advice for us to have that communication with our plan sponsors and make them aware that this could happen again. They're currently dealing with the increase in the contribution rates. No, that kicks in July 1, the increase in the contribution rates from the 17 valuation study.
You mean 3% over and above the current level?
Correct.
Is that like from 6 to 9 or from
No.
100 to 103?
From 35 to 38, or from 34 to 37.
Okay.
And that would hit at one time?
Yes,
Unless it was phased in over 3 years.
unless it was phased in.
Didn't last month when Greg was there, he said he won't be surprised if they see assumed rates go up instead of down?
No, I think that was.
That's what I was gonna say.
Well, I thought he indicated something along that line.
I know I said something like that, and
I think you definitely heard.
Well, I understand, I believe what you say, so I can see them going up
eventually,
by next year.
eventually,
Wishful thinking.
Yeah.
we're going to get back to an economic reality where we have inflation. That's going to be 2.5% to 4%. And that has trickle-through effects in the rest of the investment markets. Eventually, normality does come back. So,
I look at our investment here, you go back 1 year, or go out 1 year, to 12 months, we had 12 3/4 was our total return, and 11.16 was estimated. 3 years, it's 7.23 and 7.15 is the benchmark. 5 years, 8.63. We've been seeing this forever, that these are coming out, what really actually happens is always above 7%. And we worry about it dropping below 7%. I just
because of the
don't
unfunded liability.
understand it.
Well, the 5 years before that 5 years, I don't think that was the story.
Well, when you get out of 2008, 2009, and they're no longer in the period you're looking at, the returns are, I'd say, more normal than they were when we had that dragging us down.
what I tend to look at in terms of investment performance is the longest term view we can take, which for us is just over 13 years because of some data issues. And Callan has a slide in their quarterly reports where they're now including that very long, what they're calling a since inception number, but it only goes back about 13 and a half years. And I'm trying to find it there. So as of December, which admittedly was a very high point or close to the high water mark for us, that 13 and a half year rate of return was 7.88. And that includes the drop off in 7, 8, 9 and the recovery after. So that's the number that I like to look at. Capture both the ups and the downs, average it over the long term and see what happens. So to your point, but past performance is no guarantee of future expectations. So
Getting back to that 3% number, is there a rough dollar figure that you could peg to that? What does that 3% equate to, roughly?
I do not know. Do you recall?
I can't remember what total payroll is. I
Is
mean,
Is
it'd
it
be
maybe a million?
100 million?
No, would it be a million? What is it? What is it?
It
I don't know even. All I know is what comes out of our, which is not total payroll.
starts at the bottom.
What's total payroll? 40 or 50?
That's what I'm not sure.
Yeah.
I think it's north of that. Total GR is like 250 million annually.
Yeah. I only see what comes out
That's
of it.
total GR. Biggest portion of that's going to be payroll,
What's GR?
general revenue, general fund. I'm sorry.
Same.
So if payroll's 100 million, then 3% is going to be 3 million. I have no idea what payroll is.
I think my point was that 3% could actually be a real number.
Okay, it's
It's a lot of potholes.
it is non-trivial. It is non-trivial. So.
This was on the work plan for the year.
This was on the work plan.
So, and you're going to give this to the county, or Dan's going to give this to the county? I mean, this is.
I'll send a copy of this letter to the plan sponsors.
or and the legislation, too.
Just for
Question just regarding our next experience study, if we were to end up dropping the targeted rate of return, wouldn't, because each year our, based off our current baseline, the employer contribution is decreasing a little bit, the 3% wouldn't necessarily be 3% over what it is now, right? Wouldn't it be, by the time we would institute that new rate?
Yes, so
So that would soften it a little bit for
it
the
does.
sponsor.
If you're looking at, say we stay with the baseline for 17, 18, and 19,
Mhm.
and then we look to the increase in 20, you're actually moving from, well, it's a 2.7% increase from baseline in 19 to new projection in 20.
And then the next year, I just saw that bigger drop in 2021, and I wasn't quite following where that drop comes from. And it seems to continue to drop down a little bit. So I was just wondering if that would continue to soften.
I think, the drop in 2021 is the 5-year smoothing of our 2017
Okay.
investment performance, and we don't have any subsequent years of investment performance that get averaged off against that good year.
Gotcha.
So
So it could end up being 3%, could possibly end up feeling more like 2% for the plan sponsor.
2.5.
Okay.
I mean, it really depends on what happens between now and then,
Mhm.
and what kind of actuarial gains or losses we have to smooth in, and what kind of investment gains and losses we have to smooth in. So, both of those. The investment, the actuarial gains and losses are going to be relatively minor because they're all amortized over 18 years. But the investment gains and losses have a much more significant short-term impact in what happens to the contribution rates.
The $5 million fund could be used as
There you go.
to soften the blow.
What I'm thinking about is, because I don't deal with payroll at all, but I'm thinking about what we wire out every 2 weeks, but what we wire out is just the direct deposits, or just what direct deposits are, which there's a lot of things missing from that as far as total payroll. That's just the net.
Right.
So, and I think that's probably maybe 1.5, 2 million, under $2 million a pay period. So, but that's just, that leaves out a lot of the payroll. Okay.
Pay once a month or twice?
Twice.
Every 2 weeks.
Yeah, every 2 weeks actually, so it's a little bit more. Yeah.
Siegel gave the projected annual compensation at about 59.5 on their 2017 report, but I'm
That
not
would be
sure for
total.
county, not including courts and the cemetery district.
So that 3% would be what, 1.8?
Yeah.
1.8 million.
Of course, it could be argued that the advantage of this scenario is it's perhaps more certain. I mean, we did hear from Siegel that they gave it a 65% chance of 2 out of 3 chance of occurring versus 55% chance.
Right. Right. Any other questions? I think that completes the discussion on agenda item number 5, Mr. Chairman.
So that would put us at number 6, which is Audit and Budget Committee Charter.
Thank you, Mr. Chairman. Trustees, you have the committee charter. It's due for review this quarter. I bring it forward to you for consideration. I have no substantive changes to recommend to the charter, but would entertain any questions or comments or suggestions.
Want a motion?
I believe a motion would be appropriate.
I move we adopt the proposed charter of the Audit and Budget Committee.
I second.
Any discussion? All those in favor?
Aye.
Any opposed? Okay, passes. Now we're on to the 2018 work plan.
Okay. Thank you, Mr. Chairman. Trustees, first I'd like to address the COLA project. And I apologize for the confusion for the wrong file being posted to the website. As soon as I became aware of that, we did correct this. The earlier information was, if you happen to look at it, it was so early, I hadn't even marked it draft yet. So please disregard anything you may have seen there. So you have a memo that I've prepared on the COLA issue, and as it turns out, Trustee Sullivan was correct that we can do the reanalysis of the COLA region now because the comparison of the regions does not depend on CPI data, but on housing market data or rental data. And I recommend here that we pursue the fair market rents because that is more closely aligned with what the CPI is capturing when it's measuring inflation. And I know there was discussion about the American Community Survey data from the Census Bureau. I feel like that data is strictly dominated by the fair market rents data because the FMR data has a longer history looking at rents by county, by unit size. So it's controlling for more factors than is the American Community Survey data from the Census Bureau. So I think the reanalysis can be done in relatively short order. I'm recommending here that we add it to the work plan with the deadline in the third quarter of 2018 because we're waiting to see what state of California does in the calculation of the California CPI. So.
Because we can, should we, because when we adopted the Western region, we said we'd look at it 5 years from now. Just because we can look at it earlier, shouldn't we stick with our original plan of waiting for 5 years?
I'm willing to do whatever the board wants to do.
I was just going to throw out, to me, one of the major changes here that would warrant the earlier look is that our local area is now the Pacific, not the West. So that changed, and they redid, since they reworked the other regions. We changed our COLA policy last year, but then in the meantime, the BLS changed everything. So that would be my argument to look at it again earlier.
As a representative for the retirees, I think the move they made to separate out some states and leave some states in the Pacific will benefit the retirees. So I, as their representative, wanted to recommend that we do what is best for the retirees. And if it comes up that our cost of living is going up more than we thought it was because the CPI was being drawn down by Idaho and who knows what, our real cost of living could be going up higher than we thought it was. And if it does, we should be giving the retirees an increase that reflects what their cost of living is, what their increase in their cost of living is. So I would want to adopt whatever is the best analysis of what the real cost of living for the retirees is, not what's the cheapest.
I agree.
I think everybody agrees.
It's stability, just trying to
Yeah,
find
I mean, as
most
far as
accurate.
it's, what's the most accurate, yeah.
And that's
sound good to you? 10%.
Oh,
sound good?
10%.
the analysis that I did 2 years ago was very much about finding what's the best fit for Mendocino County from what was available at that time, which was a relatively short list. We only had 2 options that we could consider then. Now we have more options available to us in that we have the Bay Area, although with the change in the Bay Area, I'm dubious as to whether that will be a better fit for us. So we have the Bay Area. We're having discussed it with legal counsel. We can consider California. We also have the Pacific sub-region, and then we have the West as well that we can still consider. So we have more options available to us now than we did 2 years ago. And I think that was the reasoning behind doing it now. It can be completed in relatively short order. Creating a research report like I did 2 years ago, there's a lot of fixed costs in doing that because you don't know where you're going, you don't know how to do it. Once you've done something like that, it's a lot easier to repeat the process once you know exactly what you're doing. You know where the data is, you've got the spreadsheets and regressions and your data files formatted, you know how to get there from here. There's a lot less hours involved in repeating the analysis. So that's why I think we can get it done by the third quarter, if that's the pleasure of the board. I can put it off as well. It's whatever the board wants to do.
I think Tim makes a fair point that looking at the cost of housing, it's going through the roof, and the cost of replacement housing. We sort of wanted to be out of the San Francisco sphere because of what's going on there, but given the fire that we had, the cost of living in housing is, it's going to be amazing how many houses are not going to be rebuilt.
Mm-hmm.
That's going to be the big shocker.
I would like it to be looked at again. If there's more data now and there was, I think I would like to see it. I think it's too important to wait for 3 more years.
Is that a motion?
Do we need a motion on this?
I don't think we need a motion. The board can give direction because it's just adding or subtracting from the work plan.
I mean, especially with your comment that you can do it easily, I would rather it be correct, as most correct as it could be at this point in time, because there have been a lot of changes from when it was done last time.
In the sake of full disclosure, we're going to be looking at 2017 as the ending point, and it's not monthly data we're looking at, it's annual data.
So it won't include the fire.
It may or may not include the impact of the fires.
We could balance that with Costco coming.
There you go. All those people are going to come here to work with, there's going to be no houses for them to live in.
But they can buy
So they got-
milk cheaper.
There you go.
They could move into Mendocino Brewing Company.
There you go. Start a hotel. Yeah.
Okay, so
I
it
don't know how
sounds,
everybody else
it
is.
sounds like there's consensus, it sounds like, to work it, add it to the work plan, and, I presume that with this new information, we'll be getting a new report, but the intent isn't to then do another report, like, every year, but to hold off once we get this report until our next schedule was for a report, which is like 3 years from now.
We when we did the Cola region originally, there was some discussion around redoing it, and my recommendation would be that we definitely don't redo this analysis every year. I think 5 years is an appropriate time frame, barring something else changing, like the geography redefinitions. I think that's a significant enough issue that warrants a reevaluation because we get new options available to us. my recommendation would be that if we want to do the geography reevaluation now, we reset the 5-year clock from then and look at it again in 5 years.
That makes
See
sense.
some nodding heads there.
Yeah, and you recommend, I mean, it sounds, you know, when you look at this, your recommendation to us is to add this to the work plan and go forward with this. So it sounds like you're ready to dig in to this.
It can be done.
Yeah.
It can be done.
But you don't know if it will include the fire, results of the fire at this point. You don't know when that's going to come out. I don't think it's worth doing if it doesn't include that was so monumental. Of the changing.
Of course, fundamental question is how many retirees are renting? I mean, most retirees, I suspect, own a home, so they're not.
Yeah, well, that's how the, Department of Labor has always juggled it around by, well, when housing prices are going up, we'll include houses. When housing prices stabilize and rents are going up, we'll move back to rent. And the DOL has got a real reputation for jimmying the cost of living index that way.
I was just gonna say, whatever we're doing isn't perfect. There isn't a CPI for Mendocino County. We're just basically making our best effort to try to come up with it. So I feel like no matter what index we use or what data we look at, there's always gonna be something that pops up as being out of whack. But since we don't have a better alternative,
And how divergent are these different indices?
not that.
The different CPIs,
I mean, we throw them in an average amount and
it really, it depends. What do you want the number to be, and I'll find the time period and the index to give it to you.
Well, I'm just saying, if we took 4 indices, what's their difference? I mean, from 3 on one, 5 to another, or 3 on one and 8 to another, you know what I mean?
Looking at I don't think you're going to see any CPIs. I mean, the Bay Area is going to have one of the highest rates of inflation anywhere in the country because of the geography and the economics of that area. And that the rate of inflation, on average, the rate of inflation of the Bay Area is going to be one of the highest in the country. If memory serves, when we looked at this 2 years ago, the average Bay Area CPI or rate of inflation on the CPI was just north of 3%, and the average for the Western region was somewhere in the vicinity of 2 3/4. And that was averaged, I want to say, over like a 15-year period. Now, the Bay Area is part of the Western region and has a significant impact on that number, but there is difference between them. I don't think over the longer term you're going to see one at 3% and another at 6%. You may get a 1 percentage point deviation between them, if you're cherry picking over the long term. But
I mean, for sake of discussion, I'd say that, we're not the city, and we're not Kelso, Nevada. I mean, we're not in the city, but we can see the streetlights from here. And I mean, it's almost. I feel comfortable, just for sake of discussion, you take the 2 and split them, because we're not super rural and we're not super cosmopolitan either, or metropolitan. I think we are halfway in between.
there's
But you live in Mount Pleasant.
there's a little bit of a misnomer to say that Kelso, Nevada doesn't represent what happens here, and therefore we shouldn't use the Western region. Okay, I'm just I'm not defending the Western region. I mean, the analysis I did 2 years ago said that was the better fit for us. The Western region doesn't pick up cost of living in some super rural county in Idaho or Montana. Doesn't even pick up the cost of living in Mendocino County, okay? It's the CPIU, the Consumer Price Index for urban consumers. That's what we're supposed to use according to the code section. The CPIU covers nationally approximately 85% of the population in this country. Mendocino County is outside of that 85%. Okay? As is Kelso, Nevada, or I don't know, pick anywhere else that's not in a major metro. The Western Region CPI is based on the CPI data collected in the major metropolitan areas across the Western United States. Honolulu, Anchorage, Portland, Seattle, Tacoma, San Francisco, LA, San Diego, and the new Riverside, San Bernardino, Phoenix, Nevada, Las Vegas, Denver. All of these areas go into building the Western CPI. But you're not getting rural Montana, and you're not getting rural Idaho. I don't even know if you're getting any of Idaho in the Western CPI, to be honest with you, or Wyoming. It's the urban areas that they're collecting this data in. So we, like I think Patrick said, we have to do the best we can to find the best match for Mendocino County, given the choice set that we have, which includes the Bay Area, California, the Pacific subregion, or the Western region of the U.S. That's kind of our choice set. We have to find the best option we have there. So that's the problem before us. We need to pick one. The analysis I did 2 years ago looked at only two of those, the Bay Area and Western region. And the better of those two was the Western region. Now we have two additional options that we can consider. And that's why I recommend adding it to the work plan. Let's do it. And then we can reconsider it in 5 years. I think that's the best approach for us. So.
You mentioned the California CPI, but am I remembering that that's not put together by the Bureau of Labor Statistics? It's a different organization? And
It
the government
is.
code said we have to use CPIU determined by the Bureau of Labor Statistics.
It is, the California CPI is built by the State Department of Industrial Relations or Industrial Labor Relations. It's a state agency, state entity that puts that number together. But it is based on the BLS CPI. And after, as I indicated in the memo last month, Jeff and I talked through that issue. If that is a better fit for us, we believe it would be appropriate to use that because it is ultimately based on the Bureau of Labor Statistics CPI, and it does represent an area in which Mendocino County is located. So we have an argument to choose that if it is the best fit for us.
But that's also the one where, based on numbers, it was 2/3 LA and 1/3 San Francisco. It wasn't something like that in California.
It used to be a population-weighted average of the CPI for San Francisco and LA areas, and I think it was 2/3 LA and 1/3 San Francisco. I don't know yet what it's going to be going forward.
Right, and I think that's what I would love to see, if it was top to bottom, California, and that was ours, and that would be ours, and we could stick with it and get the politics out of it and just pick what's most accurate.
But it's not top to bottom.
But it's not top to bottom California, right?
It's
Bay
these
Area
two things
and Southern California and LA, yeah.
Yeah.
Right.
So whenever the state department gets it figured out what they're going to do, then we'll have certainty on what that will look like going forward, and then we can do the analysis of what measuring that against Mendocino County, because all of my analysis is built on county level data. So it's a matter of selecting the right counties for the analysis of the historical data. So I just need to know what's in and what's out.
Okay, so I think we've got direction. All right, back to the final thing on the agenda, which is the administrator's report.
Actually, I wanted to share the work plan. I'm sorry. And I was going to pull that up for us to look at. Because we have the updated work plan. Okay, and with your permission, Mr. Chairman, I'd like to walk through the projects here and update everyone and make sure we're all on the same page with these. Benefit payments, yes, we continue to get those out on time. The historical benefit review project is progressing. We are making some progress on that, about to move into the next phase of that. The disaster recovery business continuity plan, I'm still working on that. I've not progressed as much as I would have hoped, but I am making some progress, just not as much as I had hoped, which is why I don't get the smiley face there. The risk assessment, the board talked about doing that in the new fiscal year, so it's in queue now. And I can't recall if this was added since we last saw this, but we now have a beginning date on all of our projects, when we expect, or when we did begin them, so we can see when did they start and when did we expect to deliver them. I had included the COLA reevaluation here. A little bit of work has been done in building the memo to you, but there's obviously a lot more work, and we'll expect to deliver those results in the third quarter. Monitoring a strategic plan, we still do that quarterly. It's important we keep this on here. The policy review policy review schedule, we just did the only thing we had for review this quarter, the Audit and Budget Committee charter. Training, you got some more training today. We continue to search for ways to deliver that. The legislation proposal, that was deleted at board direction after our discussion last month, and adding the COLA evaluation. The organizational review is ongoing. The county is still conducting its countywide classification compensation review. I don't know. That process has been delayed somewhat, but we're still hopeful that we'll get some results this calendar year. Moving on to our client approval metrics. We had 12 members retire in the first quarter of 2018. 4 of those 12 responded to our survey, and we got a 5 out of 5 across the board on all the questions. We do still have the member handbook. That's in queue for later this year. We'll see. I'm just going to say right now that could get pushed, but at this point it's still in queue. The communication strategy is in progress, and some good progress has been. I've made some good progress on that, developing a strategy there. Part of coming out of that is I'd look to in the future bring some communication metrics to the board and report those on a regular basis, how we're doing in that area. But before we can figure out exactly what we're going to show you for the performance metrics there, we need to finalize the communication strategy. We do still have a joint meeting in queue Client presentations are still ongoing. We're continuing to work those and seeking new ways to improve those. Community presentations, I still need help, and I need to reach out to the service organizations again. So the communication strategy, plan at a glance document is in queue. Once we finish the strategy, we'll start that, and then the one pager on the UAL is also in queue. Those are expected later this year.
Question.
Yes, ma'am.
With the community presentations, are you able to reach out to the coast as well? Because there, a lot of times, I worked on the coast for 7 years, I lived here, but it was, the coast was left out of a lot of things, so I was just curious.
When I started doing this, I reached out to every civic group I could find in the county, and had some communications with Fort Bragg Rotary, I think, at one point, and then nothing ever happened. So I need to reach back out to Fort Bragg Rotary. But everyone that I could find on the internet, I sent an email to, and heard back from 3 of them, all of them in Ukiah.
Yeah.
So I do still, I am still working at getting in at the Willits Rotary.
There's a small one in Mendocino, Rotary
Right.
Club. They meet at the hotel we stayed at when we went
Oh,
up
okay.
on the coast.
Yeah, I found that with the Mendocino Rotary and sent an email and got crickets in return. So
That's a Rotary Club for you.
I should quit saying
There's
I
also,
should.
there's also the Mendocino Coast Realtors Group, so they're separate from the county-wide, the inland Realtors Group.
That's a good idea.
Actually, I spoke to them recently, and interestingly, one of them did ask about the pension plan, and this person I just happen to know is a retired state employee, so he's in CalPERS, and he asked what was probably pretty standard question, which is has the county thought of getting out of its plan and joining CalPERS? And the answer I gave was probably a different answer than I might have given 5 years ago, which is, well, actually, some of the pain that the cities and counties during CalPERS are expressing that you're seeing in the newspaper right now, and you're going to see the next couple of years, already was incurred in Mendocino County earlier because Mendocino County adopted reforms faster than CalPERS.
Good answer.
And so, the fact that we've got they're just now finally leaving the 30-year amortization, which is negative amortization of debt. The fact that they're still not quite as far. Their investment assumptions might not be as realistic as ours at 7.25, and the fact that they're phasing in the 7, or they're phasing in the 7 3/4, or 1/4.
I think they were at 7.5, and they're phasing in down to 7.2.
Okay. Yeah, so they're
I'm pulling that from memory. So
the fact is
discount
that they haven't moved as fast as Mendocino County on those two fronts, and that we're reading, because I think it is a natural question. People are seeing cities and counties are paying more for pensions, and I think it's in part because CalPERS is so big and so many people are in it. So anyway, so that was the answer I gave, and I just think that might be something that could be addressed in this. The fact that Mendocino County has actually implemented more reforms faster than CalPERS.
So I just heard that there is some misinformation going around on the coast that CalPERS, the anticipated rate of return is down to 5.8.
No.
I know that, but I mean, I'm just saying that this is what I'm hearing from
And
people.
maybe
Like,
Gatsby. would
where did that
agree.
come from?
Wow.
Yeah,
That's terrible.
That sounds like someone has pulled a number and misconstrued it somehow.
Right.
Good, back.
Either intentionally or unintentionally.
I think Joe Nation and the crew that are operating against our type extension plan are taking the Gatsby numbers and saying that that's the truth. And
What's on the balance sheet?
exactly, yeah.
So anyway, I think some point of comparison with CalPERS might be helpful for any presentation.
Okay, good point. I like that. Okay, So the board had also talked about an IT security audit. I pushed out, originally I had this with a beginning date in July. Because of the workload we've got going on now, I would recommend that we push this out to next calendar year with a 1 year expected start to finish timeline on that. Actuarial audit, we expect those results to be ready for the board at our board meeting in May. So that'll be done after next month. Our scenario review is now complete because we just did that. Our property maintenance plan for 2018 is done. If you haven't gone and seen the nice new look in our break room area, you should, because it looks a whole lot nicer now. We did the ESG divestment education. We also got the education today from Jim Failer about the investment consultants. We do have the RFP scheduled for later this year. And then next year, after we get through, so we'll be doing the RFP this year. And then in the first half, what I don't have on this list yet, in the first half of 2019, we'll be doing asset liability review again. We'll be due for that. And then we'll look at new policies and a program review beginning in July of 2019. So lots of things falling off the list here that we've made some progress on. Some new projects will be added as we complete things and expand bandwidth. So the rest of this, what I've kind of outlined is the rest of this year, the calendar year, we're putting a lot of effort into some administrative things and working on our communications, and then preparing for investments, consultant RFP in the back half of the year. And then 2019, I'm thinking we're going to be focusing a lot of time and effort in the investment space. So that completes the review of the work plan. I thank you for your indulgence. I did want to spend a little more time on this than usual. So.
You know, it's so nice to have a work plan though, so we can actually look at the accomplishments
That's great.
and what we load you up with.
Loading me up, the DRBC plan is kind of my nemesis right now, but we're making progress on it.
Okay, before the earthquake.
Slow, well, I can't promise that because I don't know when that's coming. So. Anyway, that's all I have on that.
Okay, then we're on to the administrator report.
Thank you, Mr. Chairman, trustees. You have the administrative report before you. I'd be happy to answer any questions that you may have on those.
Can you talk a little bit about the July board meeting? Is it going to be overnight, or is it a one-day go and come back, or what? Have you got that far?
Haven't gotten that far.
Okay, just curious.
Um,
And you're not leaning in a certain direction at this point?
I am not.
Okay.
My baseline would be is that it's not an overnight.
That
It's
would be
not.
driving there and then driving back?
Yes.
Yeah.
I don't see us. I'm not anticipating doing kind of off-site type of meeting during the July meeting. If we do an off-site this year, it will be at a different time, is what I'm thinking. The intent with the July meeting being at an alternate location was to have it on the coast, because at the off-site last year we discussed having a meeting on the coast at least once a year. That was a board meeting, not an off-site meeting. So
it would just maybe start a little later, maybe, and be over and back in one day?
yes,
Okay.
that's my thinking at this point, although that could change. So. Do you have thoughts there, sir, or just?
No, not on that. I'm waiting for us to get to the the pages 2 through 31 of your.
By all means.
Jump on in.
I had no specific question on any specific legislative topic there. More of a generic observation or question that might be for you or it might be for Jeff or both. I noticed a lot of the legislation, in my opinion, thankfully doesn't include the 37 Act counties. And I'm, if you look at it line by line, it's, it stirs, purrs over and over and over again. Is there some reason for that? I'm grateful for it, but in balance. But are we being is the 37 Act being overlooked by the legislature when they're coming up with these things, or is there a statutory reason why we're not included, or is it a little of both? Or?
Well, it's all political, and we have a Sackers Legislative Committee, and we've got our own 37 Act, and they might have some issues that we don't have, or for whatever reason there's not a desire. A lot of times, though, what you'll see in the 37 Act community is individual systems passing legislation that only affects them. And I guess one trend right now, not seeing it in the smaller systems, is to have the system become wholly independent from the county, and so that your employees are your employees of the system. But anyway, I'm probably going a little farther than the question you're asking. Maybe I'll let others jump in.
Well, where I'm going with this question is, some of the proposals in the state legislature that, in my opinion, are politically driven, that would constrain or direct or redirect investment decisions. And in looking through the list, I didn't see a single case where the 37 Act was listed, right? Whether it's, there was one that jumped out at me. I could look at it. The retailers, right, and the firearms, for example, were not listed. And again, I'm grateful for that, not just in that particular point, but in general. So is there a reason? I mean, if I was a state legislature and that was a hot topic for me, I would assume that I'd list every single possible pension system out there. But again, we don't seem to be included.
So, if I may, I'm going to draw on past experience, having been very intimately involved with the legislative process in another state. Legislation gets filed for all kinds of reasons. And like Jeff said, it is politics. There is politics involved here. I have seen a lot more legislators and a lot more legislative proposals than I could reasonably count that were filed purely for political reasons. And I have had legislators tell me, yeah, I just had to file that because of some reason. I'm not actually supporting that. That happens all the time. If you're looking for bang for your buck, you go after CalPERS and CalSTRS.
Yeah.
They are the two largest pension plans in the United States. They're top 10 in the world pension plans.
I thought PERS was the biggest.
No, it's second, STRS is fifth in the world.
Yeah.
So we're just not on the radar screen for tactical reasons.
I think it is. I think sometimes it's a tactical reason. Let's go after the big money. Sometimes it's a tactical, let's pick a fight with one or two people instead of 20. And sometimes it's just a matter of, it's easier to draft a bill that changes these two code sections rather than these 7 code sections.
Sure.
I mean, there's a lot of different things moving here.
Fair enough. All of that makes perfect sense. I was just curious if there was maybe some, something in Searle or, I don't know, the 37 Act that constrained the legislature's.
Not that we're aware of.
Okay, fair enough.
The reason that these items that do address PERS and STRS are included is oftentimes an idea will progress from, well, let's do it to the state plans, And then a year or two later, you may see the attempt to apply it to the 37 Act. So,
One final comment. This is the first time that I can recall seeing a list, certainly of that length, and it was very interesting. So I don't know where that came from, but I found it very enlightening.
so this is the Sackers legislative report that they put together, and in years past, I have copied this report into the administrator's report. This is the first time I remember it being this lengthy. I think it's much longer than I've ever seen. It will get shorter. A lot of these bills are dead or will soon be dead, and as soon as they're dead, I would expect them to fall off the report. That's just the normal process, that you'll have duplicative bills, and one will get advanced and the duplicates will not, and they'll fall off the report, I hope.
Thank you.
But yeah, I should have done this last month and just forgot to include it last month in my report. So
Well, thank you for including it.
I'm done. That's all I have unless there are other questions.
So just one question on the offsite coast meeting. Do you want to do a doodle poll or just ask people now to give their feedback? Would people prefer to meet, say, at 10 o'clock, or would they prefer to meet, say, at 1 o'clock? I mean, that's kind of the two times that people generally pick if people are traveling longer distances.
I'm fine with polling the board now and seeing if there's a preference or an abject aversion to one time or the other, or other options.
I could work with either one, but if I had to pick or throw my 2 cents in, the 10 a.m. would be preferable.
I would too, just for school drop off, pick up like 8 and 5 for me. That's helpful. But
Except you have to give us some lunch in there. So.
We had 45-minute long meetings, and we're out of here before lunch.
Don't challenge me.
So if we're not gonna do an overnighter, is it really worth going to the coast for this?
That drive is tough. I get sick.
The whole overnighter thing was.
You guys only have an hour to go. I have 2.
No,
We used to go for the day all the time. We drop the kids off at 8 at school, get there at 10, we stop in Boonville, and we leave at 3 and pick the kids up.
I don't want to bring another mouse home.
Whoa.
What?
Did you bring it home?
Yeah. I thought I told you.
Well, I thought you saw it in your room. I didn't think you brought it home.
No, I saw it on the kitchen counter. Then 15 minutes after I got home, the first mouse we've seen in 31 years, so I know exactly where it came from.
Wow. Are you hopping in the back seat or?
In the duffel bag that I took in, climbed in there. Said, as I zipped it up, he said, "Oh, done." I didn't send him back.
I assume that in planning this, that there'll be some attempt to advertise our presence. I guess the question is, do we think we're going to get much bang for our buck? I think the gesture is worth something.
The idea of having a meeting, at least one, having a board meeting on the coast was put forth during the offsite, and it was included in the meeting schedule that we discussed in November and then adopted in December. I think there is value in doing it. Is it measurable? I'm not certain that it is, but I believe there is value, and we would definitely do some outreach to let people know that we're going to have a regular board meeting on the coast. Is it going to change what we do or how we do it? I don't really think so, but it is an outreach and a communications effort. So I would bucket it under that umbrella.
To be more inclusive of the coast.
Yes.
What about
That's it.
waiting until September and go over, have our meeting 10 to 2 or however long it went, adjourn, reconvene an hour or so later and have it be the first half of our retreat going on till the next day. And put them together.
Wait, do we have a retreat this year?
That's an open question. So,
Well, our last offsite started with a short board meeting.
right. The, so, I'm going to answer your question, but I want to start with Patrick's question. Are we planning to have an offsite meeting this year, an offsite specific to strategic planning this year? If you look at what we've done during my tenure here, we did offsite meetings in 15. We did not do them in 2016, and then we came back to them in 17. It is often the case that organizations will have annual offsite strategic planning focused meetings. With the size of our organization and our ability to get things done and move projects along, I'm not certain that we need to have one every year. Having an offsite every year makes a lot more sense when there's a lot more changing and things are moving much more rapidly than what we are able to move things through here. So I'm not convinced that we should have an offsite this year.
We're still digesting last year. No, seriously,
I mean,
at our last meeting, we scratched off things from the work plan,
Right.
that we thought were a good idea then,
And I'll remind you, we went through and prioritized all of the ideas from the offsite, and we had a long list, and a lot of things that were on that prioritization list didn't make it onto the work plan yet. But now that we've completed some things, we're able to add those projects onto the work plan. So it's not like we don't have enough to do. My recommendation might be that we not have an offsite this year, but plan on having one kind of on a schedule of every other year is a good time frame for us to think about doing that. So that's addressing Patrick's question of do we have one? If we were going to have one, if we were certainly going to have one, I think we could absolutely do the offsite on the coast again and advertise that and try to let people know that we're having a board meeting. I'm not convinced that we need to have one, but if the board feels strongly that we do need to have one every year, I'm open to that and willing to listen.
It was just a thought, wasn't, I feel strongly about.
So,
I mean, I know CalSTRS has one every year.
Yes.
Much larger organization, they have an ability to work through projects a lot quicker because they got a lot of horses than we do.
Only 1,100.
I'm fine with doing that every other year.
Yeah.
But as far as our meeting, I think Lee may have said that it seems kind of crazy to go over to the coast and have an hour meeting. It seems like if we are going to make that effort to go over there, we need to have a 3 or 4 hour meeting. I don't know what that includes, but it feels like we need to, I don't feel like driving all the way over there and then staying an hour, maybe having lunch and then turning around and coming back.
Yeah.
It's like there needs to be, like this meeting, it needs to be a full meeting to me. I don't know, that's my thought anyway. For one thing, I don't know that I'd be able to maintain going over there and coming back that quick.
a 3 or 4 hour lunch with the bus. That's back.
Yeah, on the money. Yeah.
I
Yeah.
certainly understand that, and that's so far out, I don't have any idea what's going to be on the agenda for
Right.
July yet. But, some things I can tell you, July is the first meeting in a new quarter. So we will have policies that are up for review. We will have the work plan review for sure. Callan will not be there because they won't have the quarterly report yet, unless there's some other reason that we want them to come in and talk to us about something.
But I mean, like what we had today,
But we can
with
absolutely.
the CIO from Sonoma County, something like that. It just feels like we need to have some substance. I mean,
Yes.
not that we always don't have substance, but lengthy substance.
Yes.
We had a meeting out there, who's gonna come in? How many people are today?
Okay, you can suggest that.
It's like, there's not a clamoring audience, I don't think, out at the coast is, inviting us to go. When we get an invitation to go to the coast, why don't we consider it very favorably?
We used to have, community college board meetings in Lake County and Willits and everywhere, and I understand to do that, to give people the opportunity, but I think the key is gonna be how we advertise it or whatever. And I agree with Sherry that, to go over the work plan, line by line by line, would be a good thing for that meeting, if anybody else is in the audience. If we tell them what we're going to do, they might be interested enough to come, and then if they come, we can show them that we really are working. We're working on education, and we had a speaker, and we're working on all of these items. So I agree, the contents of today's meeting would have been a good one, and nobody may show up, but we give them the opportunity.
Also, if we have a meeting at Fort Bragg Town Hall, which I think is appropriate place
wow.
for just a straight board meeting,
Right.
it can be live broadcast on the coast and then rebroadcast over here. They've got all the equipment that the county has, or comparable equipment.
So the direction I'm hearing is, if we're going to do this, we're going to do this in July, a 10 o'clock start time, and make sure we have a substantive meeting. Is that the direction?
And I'd actually like to add one piece to that. If it looks as though we're gonna have some people, then a short education piece as to what the actual status is of the size of our portfolio, how we look over the last 10 years. People that show up will leave feeling better
Okay.
about the retirement board and system.
So one thing I could offer here is, one of the things I have a presentation that I use when I talk to community groups, and Tim and Sherry have both seen that. I could absolutely cover that because not all the trustees have seen it.
That's true.
I could absolutely cover that at the beginning of the meeting or at some point during the meeting. Kind of a walkthrough of, here's who we are, here's what we do, here's how we do it, and here's
How
what
much we have.
so.
I might also add that with the college, even if nobody showed up at those meetings, but then they came to my office 3 months later and said, you never
Right.
do anything
Right.
for Willits, and it's like,
Mhm.
well, why weren't you at our meeting,
Right.
last month or
Right.
whatever, so.
So-
It helped me.
Yeah.
It gave me
So
some
August, do you want Callan to be there? I mean, would you
In
like?
July?
No, I mean, come and do it in August and have Callan there. Would they, I mean, is that something that would be of real interest for, I mean, that's a big, big part of what we do.
It's
What are the details above the heads of who might show up?
That, probably, yeah.
And just throwing one more thing out there, summertime, I don't know if that's the best time to try to reach all the locals out there or people, because I know school's out, people are traveling, I haven't really thought about that part. I mean, if it would be better to do a meeting out there in fall, I don't know if that would
Like
increase the
September.
odds of
Who said- Somebody
turnout.
said, you said September, I
I
guess.
said, if we did September.
Yeah.
I always tell my friends, go to the coast in the fall because it's usually sunny and there's no wind.
I would rather go in September.
Yeah.
July's tough.
I don't care when we go. So be it. I'm retired.
Well, I think fall might give a better chance, but I'm open to, I'll do either.
I can do whatever the board likes. September, October. If you wanted Callan there to do it quarterly, I would lean towards October.
Why don't you run that by them?
Yeah, they're gonna be real excited.
Do you wanna
about
go to
driving.
that?
You know, they're limitedly excited,
Yeah,
marginally excited about driving to Ukiah.
yeah.
They'll be in the middle of an RFP. They'll be happy to do whatever you tell them.
That's funny.
I'm not kidding.
Then I'd like to see us do staff direction that we will meet in October on the coast from 10 to whatever substantive meeting, including Callan's presence.
Okay, what's that consensus on the board?
Everyone good with that? Just making sure.
September, October, what do you say?
October.
October would be, October, because that's when their report would be ready for that quarter, okay.
And place?
City.
The coast.
The town, we're gonna do the Fort, I like that idea.
I'd recommend town hall because of the.
Yeah, I like the town one.
Is it in November that Callan would have that September in?
You're right. My bad.
Okay, what about September, and we could still do the third, we could do the
You want to do the second
fiscal
quarter?
year ending, but still do it in, could you still do it, they normally come in what, August or September? Could we do September, if we did the quarter?
Push them to September?
July 30, yeah, so that'd be the end, June 30th, that'd be the end of the fiscal year, and have that one in September, maybe.
That's fine.
I think it, I mean,
You
it
look
would,
concerned, Judy. I just want to make sure I'm not missing something.
That's because it all falls on Judy.
Well, we do have an adopted calendar, so we did do.
oh, we have to amend that, yeah. We have to amend that at the next meeting.
I think we could do that.
So are you talking about Callan giving us our quarterly report and of the dog and pony show all at the same meeting? We'll be there all day.
Well, what were we thinking? Maybe like 3 or 10 to 3, maybe, and then have a half-hour lunch or hour lunch, whatever we need for lunch. Is that too long? Is that? And then Callan would be a good chunk of that. Would be an hour.
Yeah,
Their normal presentation would be August, right?
Yes.
For the quarter.
Yes. But we could push them to September.
So we could, August or September. But you're saying September is the best time.
Well,
Yeah,
great.
it sounds like for everybody's schedules too.
it's when it's outrageously hot here. It's
Yeah,
cool and foggy over there.
I would like that.
I would like that.
So maybe the direction would be that staff develop a plan and bring it back to the board for consideration next month as to the optimal time and place and location for having our meeting at an alternate site on the coast.
And then bring back our calendar so we can.
Yes.
And if nobody shows, then we won't
I like what
make you
Kathy
do it
said.
again.
Yeah, but like Kathy said, we're making the effort,
Yep.
and maybe they may not come this year. Maybe they'll come next year. If somebody complains, and we do this once a year. Yeah.
Okay. Direction is so noted.
Okay, so I think we're actually nearing adjournment, aren't we?
No,
We
we
have a
have a
closed session?
disability case.
Look at the excitement.
Well, it's not.
We've managed to fill every minute.
It's not there, but it's on the agenda.
Yeah, I just don't think it's fair to drag Callan up there. I mean, it's a
Oh.
2.5 hour drive for them to come here. That's one thing. It's an overnighter if they gotta go to Fort Bragg. I mean, just that.
You know, they
If I was-
get a lot of money.
One of my
for us.
customers sort of like gave me the command performance when I had to, drive to LA for an afternoon meeting.
Oh,
I
no.
wouldn't be too happy about it.
Yeah. Well, it's just that the investments is a big part of what we do, and if we're trying to go to the coast and and say what we do. That's a big part of
Yeah.
what we do.
If there was gonna be a big crowd there, then.
True,
that'd be
right, and that's another,
They'll
yeah.
spend the night, they'll have a good dinner, they'll be comped, they'll be
Yeah,
happy.
yeah, really. That doesn't bother me.
Okay, we are actually on general board member discussion. Do we have any other topics that weren't on the agenda? Okay, seeing none, we'll go into closed session. Do you want to report generally what the cases are, or the cases?
Considering service-connected disability retirement for Ms. Canna. The board voted unanimously to grant Ms. Cano service-connected disability retirement and also gave direction to staff.
We're adjourned at 5 minutes after 12.
The caterer
Audit and Budget
said-
Committee meeting. Mr. Chairman, what's your pleasure? Thank you.